we've seen equity be able to perform despite the fact that you've seen a pickup in long end yields because the growth picture has been strong.
The U.S. has a particularly good spot.
We're likely to see many pockets of volatility brought on by this drip feed of tariff news.
You can have a real kind of protracted pullback.
That is basically the story for the 2025 outlooks is uncertainty and unforecastability.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday, following a blowout jobs report on Friday, the sell-off continues. Equity futures pulling back on the S&P 500 by 0.8%. On the Nasdaq 100, we're down by 1.2. In the bond market, yields are still pushing higher. Yields up for a seventh consecutive session on a 10-year, up by 2 basis points. Your yield right now, 478.40. And to make this mix just a little bit worse, crude, 5-month highs. Brent crude back through 80, make it 81.15, going into a massive week ahead. On the data side, PPI, CPI, retail sales, then earnings, big bank results kicking off on Wednesday.
You put all of this together, a real question about whether the data that we get this week will confirm what we saw in payroll's report that really spoke to the American exceptionalism, or whether it will defy it. If you get this sense that the U.S. is continuing to diverge and you get this dollar strength ongoing, you get yields higher, you get the idea of a potential Fed rate cut pushed off the table for 2025, does that only make the pain worse in global markets?
It's good news, bad news. And I think we spent Friday morning talking about that. You were the first one to ask the question. I think poured some freezing cold water over it as well, and you were right to. Stuart Kaiser agrees with you over at Citi. Good growth data outweighs higher 10-year yields, but unless and until inflation surprises, and I think we can't talk about Friday by just talking about the payrolls report. You've got to throw in you, Mitch, as well, and inflation expectations, because that poisoned the well too.
The idea that 5 to 10-year inflation expectations came in at the highest levels going back to 2008, rising to 3.3%. If you look under the dynamics of the University of Michigan sentiment survey, you could argue, again, this is a political barometer because Democrats increased their expectations for inflation dramatically. Republicans ratcheted back their expectations for inflation, and that seemed to be the divide. That said, this has driven inflation in the past, and this is something the Fed looks at. So even if it's political, can you take it off the table?
The political breakdown is on the edge of comical. I agree with you, Mitch, on Friday. This move in crude won't help. Brent crude this morning up by 1.7%. Anne-Marie, WTI up by close to 2%. $78 a barrel.
And you're seeing a lot of analysts come out raising their expectations. Morgan Stanley modestly talking about the expectation of Brent going higher. And this is because we've seen the boldest and most significant sanctions placed on Russia and on their crude at a time when an outgoing administration, even though this war has been raging on for years now, decide to take the most significant steps at a time when on the horizons there still are concerns of other pockets of crude supply, most notably when the Trump administration comes in and they go back to maximum pressure campaign on Iran. And that is why you are seeing not just what is happening right now with Russia, but also future. What does this mean for supply in the oil global market?
This you can file under the parade of things that maybe President Biden wanted to do before the election, but now that it's over, go full throttle, let's go, and do all the things that really he feels like are now politically insensitive. Question about whether this adds insult to injury longer term, because essentially if people are worried about the deficit, if they're worried about the idea of inflation, this doesn't help.
It's certainly hurting the equity market. We're down by 0.8% on the S&P 500 to kick off the new trading week this Monday morning. Coming up this hour, we'll catch up with Beata Manthey of Citi, looking for equities to bounce back. Meyer McGuineas of the Committee for a Responsible Federal Budget on the cost of rising bond yields. And we'll speak to Mark McCormick of TD with the United States and the US dollar on a 6-week winning streak. We begin this hour with stocks falling as traders dial back Fed rate cut bets following a blowout jobs report. Beata Manthey of Citi expecting equities to rise in the year ahead, writing, quote, full-year returns should be more evenly spread between regions, though broadening dynamics may need to wait until we move further past Inauguration Day. For now, we maintain our overweight stance on the United States. Beata joins us now for more. Beata, welcome to the programme. How much of a challenge is this bond market to your call?
Morning. Thanks for having me. What a busy Monday morning it is. So, equity market, so what you've quoted is quite a constructive view on equities, but it's going to be a volatile year. and there's going to be a lot of uncertainty there, right? So yes, our core overweight still into the inauguration and at the start of the year is the US. But what we've been flagging since the fourth quarter of last year is that the US market is really priced for perfection, and that's where pressures from the bond market could come stronger than elsewhere, like any other factor as well. So what we've been arguing is that now is the right time to start diversifying from very expensive price for perfection US equity market into the rest of the world bucket. Now, within the rest of the world, our model suggests that the market that has been most beaten up through all various pressures in the second half of last year is the continental Europe. So this is our preferred diversifier. And of course, when the US is under pressure, all of the markets are going to go down. But you've been seeing this dynamic starting already, that big pressure on NASDAQ or S&P doesn't necessarily translate in the same amount of pressure on the rest of the world equities, and especially in Europe.
Beata, the idea here is that you guys are upgrading Europe to overweight at a time where you're concerned about the whole price for perfection idea in the United States. And this goes to this question of, is it just that the bar is so low in Europe, or do you actually see something positive coming out of the region? And I don't mean to sound snarky, but we're talking at a time where you have inflationary pressures ongoing, you have governments in disarray, and you have the potential of China's slowdown just basically eating into the region as they get caught between trade wars.
Absolutely. So these have all been pressures on Europe playing out since the summer last year, right? So we downgraded Europe before at the beginning of June with the French election announcement. Then China slowdown happened. The biggest bulk of these pressures through downgrades on EPS in Europe has happened in the third quarter of the year. We've been noticing back then that EPS downgrades from the analysts have reached recessionary levels of downgrades, of cuts. And historically, actually, it tends to be a contrarian buy indicator for cyclicality in Europe if you have a patience of waiting 6 to 12 months. So that call has started to work. The pressures continue, but these are not new pressures, right? So the market through its underperformance versus the US has had time to price many of these in. And what we see right now in terms of, we have this proprietary what's priced in for EPS model. It's a rate adjusted model as well. And what it's telling us right now is that markets like Europe or emerging markets, the more beaten up markets in the second half of last year, are now pricing in line with this already cut EPS forecast from the analysts, right? So it's a more reasonably priced market. The US is priced for perfection, double analyst forecast. So this is where we are. Of course, it's not a smooth sailing ahead into this year for Europe, but there is a huge amount of bearishness already priced in, that's all.
This goes to the point of the weakest euro right now versus the dollar since November of 2022. Dollar strength, basically money flooding into the U.S., which is going to your point of price for perfection. And I just wonder whether the currency plays into this, whether a strong currency actually will impede earnings and exports, and whether a weaker currency actually provides a tailwind to European companies.
The way I look, this is one of the potential catalysts, right, for Europe going forward. And currency, absolutely, the magnitude of moves that we've been seeing last year has been very meaningful. And when dollar is so strong, and most of the assets and investors are dollar denominated, you stay with the dollar denominated assets, as simple as that, right? Now, from our FX strategies perspective, perhaps we have another 1-2% move stronger on the dollar, but most of these moves are already behind us. Ideally, for bull on Europe, you'd like a weaker dollar. However, within the European market, we argue that the market has been very one-way positioned, just thinking about the negative. So exposure to the US, but because it's a tariff risk, very indiscriminatory treatment that we've been noticing around the presidential election. The market forgetting about the positive, so the big dollar exposed stocks have underperformed, but actually they benefit from the strong dollar.
A lot of negatives to think about, and that's the problem. Beata Manthey there of Citi. Beata, appreciate your time. Thank you. Euro dollar breaking down through 102 in this morning's session, 101.97. The lower of the session, 101.78. Just on the European stock performance, just a little bit of outperformance on the Euro Stoxx 50 more recently. That's worth watching. But to your point, Lisa, Torsten Slok of Apollo, I felt like over the weekend he wrote this just for you. The narrative in markets is that the outlook for the US is great and the outlook for Europe, UK and China is not good. For markets, the problem with this narrative is that 41% of revenues in the S&P come from abroad.
I loved this line, and I love this idea, not because I think that it's wonderful for equity markets, but because essentially, how divorced can you say you are from the global market? How much can you talk about American exceptionalism and basically this wall of protection around U.S. companies if they derive 41% of their profits from the rest of this world, which goes to the European strength? How much of the European strength comes from companies who derive a significant portion of their sales from, guess where? The United States. And they actually can do a significant more exporting business because the euro is so weak. So it just goes to this question and it challenges just how much you do have this divergence.
A break of 102 on euro dollar, a massive week ahead. We've got PPI tomorrow, then we've got CPI, then we've got retail sales. On Wednesday, a long list of banks start reporting earnings. JP Morgan, Citi, Goldman, and Wells Fargo. Before we get to all of that, let's give you an update on stories elsewhere. With your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. The wildfires in Southern California have killed at least 24 people and destroyed more than 12,000 buildings. Over the weekend, firefighters got a brief break from the dry Santa Ana winds that have spread the flames across nearly 38,000 acres. However, another round of wind gusts is expected to pick up later today. The National Weather Service issued a rare, particularly dangerous situation red flag warning for parts of Ventura and Los Angeles counties from early Tuesday morning until noon on Wednesday. Incoming U.S. Vice President J.D. Vance says a deal to release hostages held by Hamas could be struck before President-elect Trump returns to the White House. Vance told Fox News it could happen in the last day or two of the Biden administration. Israel said that it sent negotiators to Qatar for fresh talks. The U.S. Supreme Court, meanwhile, signaled that it is likely to hold up a law that would ban TikTok if its Chinese parent company, ByteDance, doesn't sell it by January 19th. A majority of justices suggested that they see national security concerns as overriding the free speech interests of companies and content creators. ByteDance argues that TikTok is an American company incorporated and headquartered in California. And that's your brief. John.
Danny, thank you. More from Danny in about 30 minutes. Is this about free speech or national security? Because they are two very different stories.
Well, when you look at what happened at the Supreme Court, it sounds like they are very concerned with the tone and tenor about national security. Chief Justice John Roberts asked the lawyer, are we supposed to ignore the fact that the ultimate parent is in fact subject to doing intelligence work for the Chinese government?
Over the weekend, that cry that you heard in the streets was a whole host of teenagers realizing that TikTok was going away and trying to figure out what they were going to be doing.
Well, Ed Mills said to me last week, it can get banned on the 19th and then back on the 20th, and Trump can give it a 90-day extension, one-time extension, and they try to figure something out. But
Sure.
it's very difficult, the parameters of how this deal could get done.
In the meantime, if your social capital relies on TikTok, you are looking for diversifiers. That is what I've seen from a homeland bias.
The clock is ticking. And Mark Zuckerberg's waiting in the wings.
Oh, 100%.
More on Zuckerberg a little bit later in the programme. Up next, drawing a red line on Trump's tax cuts.
We will work through this negotiation with the president, with our leadership, and come up with a number that works. If there is a tax bill that does not lift the cap on salt, I would not support that.
That conversation up next, live from New York City this morning. Good morning. Equity futures on the S&P down here by 0.8%, building on the losses from Friday post-payrolls. Bond yields still climbing. We're up 2 basis points on a 10-year, just south of 480 on a 2-year, back through 440. Bank of America, Aditya Bharve and the team. With inflation stuck above target, the labour market stabilising, we no longer expect any additional rate cuts. through this year and in line with Matt Lazzetti over at Deutsche Bank.
And previously, they had expected 2 rate cuts, so this was a huge change for them. And this is basically something you saw across the street with strategists at all the big Wall Street firms cutting their expectations for rate cuts. And this really speaks to how the entire yield curve is shifting upward as people talk about higher for longer. And oh yeah, maybe where we are right now isn't that restrictive.
Neil Datta of Renmac pointing out one area of the economy where things are restrictive. Housing is simply not working. Mortgage demand is crumbling.
And we're seeing that climbing above 7%. You could see mortgage applications falling off a cliff. We have seen this, though, consistently for the past couple of years. It hasn't led to necessarily huge price disinflation or deflation. And this hasn't been the breaking stick for the Federal Reserve. So the ongoing more of the same, does it start to actually eat around the edges?
Keep this move on your radar as well, this move in crude. WTI is up by more than 2%. Crude at the moment, 78.20 on WTI. On Brent crude this morning, through 81.25. If you're the incoming president, you probably have some pretty strong thoughts about the outgoing president and some of the moves he's making over the past week.
Right. There's been a flurry of activity in the final weeks of the Biden administration, even though they could have taken a lot of these packages under consideration the prior year or two. When it comes to this one, someone sent me a message, a source sent me a message saying, one thing I want to make sure you realize with these sanctions is that Trump cannot just quickly lift them if he wanted to and is doing a deal with Russia. He actually needs to go to Congress to get congressional approval. So this is another reason why these sanctions have a little bit more bite to them than I think most people potentially, when they just see them on the surface, were understanding.
Inauguration 1 week away. Under surveillance this morning, drawing a red line on Trump's tax cuts.
There's reason for all of us to negotiate in good faith. That's why we went down to meet with President Trump. He understands this. And he said to us, look, I'm with you. Come back with a number and let's work through it. And that's our objective. We will work through this negotiation with the president, with our leadership, and come up with a number that works as part of the overall tax bill. The only red line I have is that if there is a tax bill that does not lift the cap on salt, I would not support that.
So here's the latest this morning. House Republicans meeting with President-elect Donald Trump over the weekend to discuss the salt deduction cap, calling the talks positive, but saying they got no firm commitments from Trump. The move shaping up to be a key sticking point for passing an upcoming tax package. Joining us now to discuss is Meyer MacGuineas of the Committee for a Responsible Federal Budget. Meyer, welcome to the programme. I just want to start in the market and then get to some of the politics. How much more expensive is this bond market making the ambitions of Washington, D.C.?
Yeah, the bond market is a wake-up call for when you have trillions and trillions of dollars of debt. Higher interest rates have a profound effect on your overall budget. And so the fact that we'll be paying $1 trillion in interest payments this year, second largest item in the federal budget, squeezes out the space for talk of anything else. Spending increases, tax cuts, and it puts real pressure on the lawmakers to start thinking about fiscal issues, which is something they have been ignoring for the past years. And it is a reminder that there are real effects of borrowing too much, and we're starting to feel those effects. And this huge debt load is incredibly sensitive to those swings in rates.
Well, incoming Vice President-elect J.D. Vance certainly taking notice of the bond market. In his interview over the weekend with Fox News, he mentioned bond yields rising twice and that net interest payments, Meyer, you're talking about last year being more than $1 trillion. What are they on track to be this year for 2025? This year they'll be over $1 trillion as well. Yeah, it's that's pretty incredible, and in terms, it doesn't really give the incoming administration or Congress a ton of wiggle room. If that is how much we are spending and the bond market is pushing back on some of this spending, what do you make of all the talk of reconciliation, tax cuts, more money for the border? Do you have an understanding from Congress on what the top line figure would be? No, that's the big fight in Congress right now. So on one side, and this is the side that I have a preference for, there are members who are saying, my red line is, I don't want to add to the debt. Our debt is too high. The only way that you change that you break that fever, is you start using reconciliation and budgets and other tools to bring the debt down. So there are some members, and they're not enough, unfortunately, who are saying, I don't want to vote for something that would make the debt worse. But the discussions internally are talking about huge numbers, because the tax cuts, extending them without offsets, would be so expensive that there are discussions of a reconciliation number as high as $4, $5, $6 trillion in new borrowing, which would be astronomically dangerous to the fiscal situation that, as just mentioned, the bond market is already showing real nerves about. How long do you think they will extend TCJA? Because they want to keep the top line number down, but they definitely want to make sure that they can get these tax extensions through.
Well, you've honed in on one of the possible and, in fact, likely gimmicks that there is. So tax policy should be permanent. The purpose of tax policy is to allow individuals, families, and businesses to plan with certainty. But one of the tricks to keep the cost of the bill down when you're using reconciliation is to make those tax cuts temporary. That's why we're dealing with this now, because they weren't permanent. So the first effort will be to have offsets, to have spending cuts that will offset the cost of extending the tax cuts. But I worry, and I think it's likely that in the end, a number of those extensions will be temporary, talking about just 2 or 4 years, which will hide the cost, mask the cost. We'll be back at the table having the same discussion in a couple of years if they do that. And none of the entities will be able to plan with the certainty that would make their investment decisions much more beneficial to the companies.
How optimistic, Beata, are you about the Department of Government Efficiency?
I'm a huge fan about the DOGE effort. I'm really excited about it for 2 reasons. One, it's so clearly needed. There are huge pockets of places where we could have massive savings in the federal government, from procurement for defense, from a huge healthcare industry that is remarkably inefficient in almost every aspect of how it works, to the regulations that they're looking at. So I think that's very exciting. I was concerned when they came out and said, we're going to save $2 trillion in a year, because that fiscal ambition is so far from reality that I was worried this was all bluster and kind of like the California hype cycle more than the reality of how budgeting works. But as I've seen the efforts that they're putting together, and they've walked back that metric, saying we're going to get as much as we can, $1 trillion, maybe more likely over a year, I continue to be encouraged. I think that they will find a lot of places in executive orders where you can save money. I think they will find a lot of regulatory changes. I just hope they're not all directed towards loosening regulations in the financial industry on crypto and AI, rather than thinking about where you can make things more efficiently and actually save the government real savings. The hardest pockets, though, are Social Security and Medicare, and they have said those are off the table. And as far as I'm concerned, that's really one of the tests of seriousness. Are you willing to go to where the money really is? So far, they have said that that is a red line. I get it. Politically, those are hot buttons. Nobody in Congress wants to touch them. But anybody who's serious about the budget knows that those are where the real savings are.
When you talk about they, we're talking about a sort of loosely brought together coalition of people in an area that isn't actually a department. They're not actually government officials. And there's a real question about what kind of political clout they'll have, especially at a time where everything gets watered down, when you have constituents that want everything. So at what point do you believe there's a political will to get through some of these cuts that might be recommended by DOGE?
It's a great question. I'm on one hand on the other today. But on one hand, I think we actually need to outsource some of this. Congress has failed to do its job when it's come to fiscal oversight and the fiduciary responsibility for over a decade now. And it's been really disheartening to see that the only party that cares about fiscal responsibility is the minority party trying to stop the other one from doing something. There are very few people out there really talking about how to reduce our borrowing. So I think that's great. On the other hand, obviously, a lot of the people who are involved in this have a number of interests and potentially conflicts of interest with the federal government. And I think that's really worrisome at a time when we need to be rebuilding trust with how our leaders are serving as stewards for the overall economy and not just looking after their own interests. So I think their ability to disrupt and not care about the political constraints is incredibly encouraging. But I think we have to make sure that they're very transparent about how they're doing it. Biggest concern I have, President Trump, we've seen him in office before. He was not a fan of spending cuts. In fact, he increased spending massively on top of huge tax cuts, and the debt went up under him a lot because he hasn't liked to say no to things. So I think you may see a real political meeting of the minds between those working on DOGE, the opposite of meeting of minds, between those working on DOGE and President Trump, who, when he realizes how hard these things are, says, ooh, that politically is going to be difficult. And I don't know how that will play out.
We'll see if it's any different the second time around. Meyer, appreciate your time. McGuineas there, the Committee for a Responsible Federal Budget. Up next on the programme, Nela Richardson of ADP, joining us ahead of CPI data later this week. From New York City, this is Bloomberg. Posting a second straight week of losses on the S&P 500. Coming into Monday and the losses continue. We're pulling back by 0.8% on the S&P, on the Nasdaq down by 1.2%. Similar move on a Russell. The wire is all over the place. It's in the bond market, it's in commodities as well. So let's get to fixed income first. Yields up again by 2 basis points. Yields are climbing for 7 consecutive sessions, close to 480. 477.99. Wasn't just payrolls on Friday. A few hours later, Lisa, we got the UMich inflation expectations read, and that wasn't pretty either.
The idea that some people were saying you can basically discount some of the strength in the payrolls report by saying that the inflationary impulse in the wages was shattered. When we got the University of Michigan sentiment survey, people looked at the actual details. They said, okay, this is Republicans feeling fine about inflation and Democrats feeling terrible about inflation ahead, and it led to the highest inflation rate going back to 2008. Nonetheless, it really puts that much more pressure on Wednesday when we get that CPI print, and it just speaks to how jittery this market really is.
So you can always poke holes in UMich. We often do on this program. The survey director said this: nearly 1/3 of consumers spontaneously mentioned tariffs, up from 24% in December and less than 2% before the election. There is an important piece of information there, I think.
People are concerned about what's to come and the sort of threat of policy to come. And frankly, I wonder if it's just consumers or whether it's also companies. And one thing that Mohamed El-Arian was talking about on Friday that I thought was fascinating is companies aren't going to deal with tariffs the same way this time as they have in the last. They don't put prices anymore on the packaging. They can adjust pricing in real time in a new kind of way. And consumers are used to not being able to check prices because they've been moving so quickly.
They're going to move even faster, potentially, in the months to come. I want to turn to crude just briefly to give you some numbers. Crude's rallying once more, higher by more than 2% on WTI, 78.11 on Brent crude, back through 80, 5-month highs, up by 1.8%, 81.16. We'll come back to that move in just a moment. Under surveillance this morning, 2 rounds of dry Santa Ana winds are heading for Southern California as fire crews struggle to contain the massive blazes in the region. The National Weather Service issuing a particularly dangerous situation warning for Malibu, the San Fernando Valley and Ventura County, with 70-mile-per-hour winds forecasted from early Tuesday through Wednesday morning.
It's horrendous. To give some perspective, the 40,000 acres that have burned accounts for something that is bigger than the city limits of San Francisco, Pittsburgh, Boston, and Miami. It is a shocking amount of land. There now is the question of, is this something that is a result of global warming? Is it something that as a result of human failure and planning? Or is it two stories that can be coexistent, where there are climate changes happening and it is getting more expensive and more difficult to adequately respond to it at a time where authorities really need to do so?
The destruction is pretty shocking. The Palisades fire is the 3rd most destructive in state history. The Eaton fire, the 4th most destructive in state history. These are all the wrong kind of records.
Absolutely. And you have AccuWeather coming out over the weekend talking about the total damage and economic losses. Tragic, $135 to $150 billion. And this is before the fresh news we have of these tragic winds that are going to be picking up, and potentially the fact that these fires are not abating just yet. This economic toll is going to be crushing on California.
We'll talk about federal assistance later on in the program, but the incoming administration, the tension between President-elect Donald Trump and Governor Newsom, I think, is worthy of attention through the next several weeks or so. Back in September, President Trump said, regarding his demands for water delivery and forest management, if he, Governor Newsom, doesn't sign those papers, we won't give him money to put out all of his fires. Of course, context matters here. This was back in September. People around the incoming president have said he will continue to help in the same way that President Joe Biden has, but I wonder how much will change in the next several months around this issue.
He's going to want to make a trip out there, and he's going to want to point to what he perceives as the failure of governance from Governor Gavin Newsom. J.D. Vance, though, was over the weekend asked about this, and he said that the incoming administration intends to have FEMA and other federal responses continue to help, but also saying better clued in on what's going on the ground. So I think they're going to want to take a more hands-on approach on California.
More on this story a little bit later. I promised you an update on crude again. Crude surging to a 5-month high. All of this following fresh US sanctions against Russia's energy industry. The measures targeting large exporters, insurance companies and more than 150 tankers. The move potentially forcing refiners in India and China to seek alternative supplies. A big question about the timing on all of this.
There's a lot of question about the timing. Many people are being very critical of the Biden administration. This war has been raging, Russia's invasion of Ukraine, for years, and now they're waiting for the final weeks to actually really make a bold action when it comes to sanctioning, not as much as the U.S. has sanctions on Iran, but closer, much closer, going after Gazprom Neft and Surgutny Gas. These are two massive producers. We're talking about 800,000 barrels of oil, and it comes at a time when there are critical concerns about supply in the oil market when Trump comes in terms of maximum pressure on Iran. So how much more can we see risk premium added to the price? I will say, if you're Saudi Arabia or the UAE, you might be liking this. And you're probably reaching out to China and India and saying, we'll fill that gap.
All I could say is, what's next? He's got a couple more days. I saw the tour. I mean, it basically is the last week, tear and reap his consequences that he's been looking to do that have no political, really, back through to him.
Watch this space. More still to come. There's 1 week to go. A week until inauguration. Elsewhere in China, trade surplus there, reaching a record $992 billion in 2024. That's 21% higher than the previous year. Exporters rushing to make up for sluggish demand at home and get ahead of President-elect Donald Trump's return to the White House. An interesting detail in this export data, Vietnam overtaking Japan as China's third largest export destination for the first time. I'll bring you some of the numbers now. Exports to Vietnam in 24, rising almost 18% to a record $162 billion.
And where are those exports going? They're not going all to Vietnam. They're going to the United States. And this goes to the whole point that we keep hearing about, that a lot of the trade restrictions have just created markets in places like Thailand and Malaysia and Vietnam that act as sort of third parties that can take in those exports from China and then repurpose them and put a Vietnam or a Malaysia on them and send them back to the U.S.
It's the backdoor way of this idea of friendshoring, which is why you see really both parties also talk about the concerns with Mexico and China building these factories on the border with the United States. Back to the other story on oil. To your point, Lisa, sanctions don't always work. Sanctions just create new markets. Someone at some point will fill those demand. The question I have for China overall, though, is this really about Trump and his tariffs? Or how much is this about the fact that China has a really sluggish economy? They don't have the domestic demand. So if they can use anything, any nervousness in the market and the economy about the incoming Trump administration, they're going to do it to try to dump their exports somewhere else.
Two important dimensions to the same story. Let's turn to the data coming through this week. CPI out on Wednesday after December's blowout jobs report. Nela Richardson of ADP writing, given the uncertainty of last week's jobs report, the CPI will either reverse Friday's market sell-off or justify it. Nela joins us now for more. Nela, good morning. It's good to see you again.
Good morning. Good to see you.
256,000 on Friday. How strong was that 256,000 beneath the surface?
You know, it was, according to the report, it was driven by private sector jobs. 223,000 of that 256 came from the private sector. The last time in September that job gains were this high, it was driven by government and healthcare. So this is actually a sea change. It's the same number as September almost, but the composition changed. And it looked like from that report that private sector was accelerating at the end of the year.
So, and I know that the ADP report doesn't necessarily track with the same kinds of metrics that the non-farm payrolls report does. But it was actually a lot less optimistic.
It was.
And I'm wondering why the dissonance there.
We saw a downshift in private sector hiring. And you're right, part of this is a data construction difference. BLS is counting the number of people who received a paycheck. ADP is counting the number of active employees on payroll. And we are seeing that disconnect in the broad numbers. But let's focus on the areas of similarity. Manufacturing shed jobs in the ADP report. Weak in the BLS, healthcare was dominant in both reports. But overall, yeah, we're seeing a slowdown in job growth, not an acceleration.
Which is the reason why I saw a number of reports, in particular from Manthey on macro, talking about the likelihood this was going to get revised lower, because they actually questioned some of the responses to the surveys. Would you agree with that?
I think history has borne out over the course of the year that we've seen big revisions in the BLS first print. And that's because the survey response rate has come down. So by the second, third print, you're getting a much more robust number than we see in the initial number. But the issue for the markets is you trade on that first number, not the third. And so that's why I think looking at these two reports gives you a range of what the private sector is doing.
So based off these two reports and how the market reacted, even though you think maybe it's going to get revised, how offsides is the market going to be for that potential revision?
Well, if the market, maybe this is an educational opportunity, if the market is looking at wages, wages are going to tell you a different story than that really robust 256,000 number. It's going to tell you that wage growth has stepped down a little bit in both reports. And if you follow the wages to inflation, that means lower labor costs, and you match that with higher productivity gains that we've seen so far, you might get a better feeling in your stomach going into January that at least wage growth is not likely to trigger inflation.
We talk about this a lot because you do a lot of work looking at workers and employees. Who has the leverage right now?
Well, I don't think anyone has the leverage. If you look at the historical level of layoffs we're seeing right now, it's very, very low. So employers are keeping their employees tight. And what employers are thinking about is not how to add headcount or replace headcount. They're thinking about how to make their headcount more productive, how to make their workers more skilled, how to engage them and how to keep them. At least that's where we are right now. So we're in this moment of stasis where neither side has the leverage to until we go further into the 2025, where I think we're going to see employers dominate the labor market this year.
Nela, there were some big moments in Q4 where the data was quite disrupted by strikes, by other things like hurricanes as well. We've got another big issue to deal with now. How disruptive will the incoming information be now, given the wildfires in California?
If you use the hurricanes as an example, the damage they did in the Carolinas did show up in that jobs report. And I would think that LA, being the massive market in terms of job creation that it is, especially for retail and leisure and hospitality and the service sector, and you match that with the massive amount of damage and destruction we're seeing on the ground, I think it will have an impact in the jobs report, maybe not in January, but also in future jobs reports as well.
One of the biggest economies, not just in America, but on a planet.
The 7th largest in the world is California, and LA is a key component of
Amazing.
that.
Yeah, honestly, this is absolutely tragic and will have ripple effects at a time where you have to wonder what other effects it will have, like on housing prices. I mean, talk about some of these regions that don't have a lot of housing supply where prices were going up. Well, you have this type of situation. Doesn't that cause inflation on some level? Doesn't that actually really create demand for a lot of these workers?
Right. And it's not just about housing, which is a key component of inflation, as you mentioned. We've been tracking that all year. It's also agriculture. We're talking about a highly dense area, but we're also thinking about how this affects, how it has ripple effects into other industries that are dominating California. And so if you're looking for places that will trigger inflation, I would look away from the headline jobs report in December and these pockets of activity that have been compromised by climate events.
Nela, appreciate your time this morning. Lots to think about. Nela Richardson there of ADP. Equities this morning lower once again, building on last week's big losses. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. It's Danny Berger. Hey, Danny.
Hey, John. Vice President-elect J.D. Vance attempted to dial back the campaign's promise to pardon all protesters involved in the U.S. Capitol riot on January 6, 2021. Vance said those who behave violently should obviously not receive pardons. President-elect Donald Trump has also modified his stance, saying many will be pardoned and there could be exceptions for people who, quote, got out of control. Apple trading lower in the pre-market this morning by just under 1%. The company sold 5% fewer phones globally in the final quarter of last year. It was due in part to the lack of Apple Intelligence features on its latest iPhone 16, which are still not available in China. Apple's market share slipped to 18% as Chinese rivals like Xiaomi and Vivo gained ground. Samsung, for its part, also lost share. Blue Origin has delayed the inaugural launch of its new flagship rocket this morning, dealing with an unspecified issue with the vehicle. The Jeff Bezos-backed firm is trying to mount a challenge to Elon Musk's SpaceX, but it repeatedly delayed its targeted liftoff time during a 3-hour launch window in Cape Canaveral, Florida. Blue Origin didn't give any detail on when it would next try to fly the New Glenn rocket. Bezos told Bloomberg on the eve of the attempt that the space industry has room for multiple winners. And that's your brief, John.
Danny, thank you. More from Danny again in about 30 minutes. Up next on the program, dollar strength.
The dollar's benefited. The EM currencies have not benefited, and and the rest of DM has been suffering. So the dollar move and the rate move in the U.S. Combined really does start to kind of cause issues for all markets going forward.
That conversation continues up next on the program, live from New York. You're watching Bloomberg TV. Not a great mix this morning. Crude higher by 2%. Bond yields elevated by another 2 basis points. The 10-year just south of 480, bringing equities down with some more dollar strength. We're negative by 0.8% on the S&P 500. Under surveillance this morning, dollar strength.
The dollar's benefited, the EM currencies have not benefited, and and the rest of DM has been suffering. So the dollar move and the rate move in the U.S. Combined really does start to kind of cause issues for all markets going forward. There's only 3 ways you can fix that U.S. outperformance. Either the rest of the world catches up, the U.S. goes sideways, and nothing ever goes sideways, or the U.S. goes down.
So here's the latest this morning. The US dollar surging to its highest level since November 2022, following an upside surprise on payrolls. Mark McCormick of TD Bank writing, the dollar remains the only game in town, and US data is getting better, not worse, supporting a solid backdrop for US flows. Mark joins us now for more. Mark, welcome back to the programme, sir. Talk to me about those flows. You've talked in the past about the importance of the performance of a domestic equity market, and I think there are some subtle signs that just more recently you've started to see some performance kick in on a Euro Stoxx 50. How important is that?
Well, I think what's important is it's kind of U.S. equities are slipping, but everything else is slipping almost harder. You can see that, Euro stock has not declined by as much, but if you look at local currency terms or adjusted for currency flows, it's down pretty significantly as well. I think a piece of it is that the rates market, the tightening of financial conditions is feeding back into equities, and it's causing risk off, which is now feeding back into the dollar. So now you're kind of moved to the other side of the smile where the world's kind of looking like it's in a worse place. And now we're seeing oil prices rising. And it feels like the themes are US is exceptionalism. Europe is more stagflation. And the more that we see kind of elevated oil prices and we see slowing growth in Europe and we see somewhat like sticky inflation, this is not good for European currency. So it's still, again, regardless of positioning or valuations, the market is transitioning into a new environment. And this price discovery is still bullish for the dollar, especially when we look at the data, which is where we were last year, data dependent. It's data dependency, geopolitics, geomacro, and Trump 2.0 are still going to be bullish for the dollar.
Mark, when you see big, powerful moves like this, you know better than most, it's not much time for nuance, but if we could take just a minute or so for a little bit of nuance. When you look at various currency pairs at the moment, are there currency pairs where this dollar is inflicting unnecessary pain? And are there currency pairs where this dollar is forcing a necessary adjustment? How would you draw the distinction between the two?
So I think it's kind of a massive wave that's hitting all of them at the same point. There's just so much unpredictability. Again, you think about CAD. I don't see the reason why CAD should be a part of the discussion on U.S. tariffs. Again, there's a piece of it. The big driver of the U.S. trade deficit with Canada is energy that's refined basically in the U.S. So it's not that it's not like when you talk about the trade surplus in China, which is, again, one of the main things that Trump's focused on is kind of reducing that trade deficit with China. That's not the game with Canada. Maybe, again, that's the game with Mexico. Again, you look at Europe. Europe has the same composition. Germany has the same export composition as China, which is why it's been so challenging for Germany to remain competitive, which is why we're seeing the political uncertainty in Germany. Its business model is broken from what we've seen over the last 20, 25 years. So I think when we think about the currency pairs, everyone's kind of being impacted by the same uncertainty, which again is reinforcing the strength in the dollar. But the key thing that's happening is governments are trying to find ways to stimulate their economy at the same time that inflation is elevated. So you see fiscal and monetary policy working together, and rates are selling off and curves are steepening. And that's creating a lot of panic and uncertainty. And this is just an environment, again, given the outperformance of U.S. data, where it flows back to the dollar. So euro, sterling, CAD, MEX, they're all going to continue to underperform. I think the one place you want to look as a hedge is, again, being long the yen, because the BOJ is probably going to have to hike again very soon.
Your defense of the Canadian loonie made me think maybe he's running. I mean, at this point, pretty much it's a pretty open field. I am wondering what you think about 6 months forward, because some of the interesting Wall Street prognostications are exactly opposed to one another. Goldman Sachs' Kamakshia Trivedi talking about we expect the dollar to rally by 5% over the coming year, pretty much in line with a lot of people what they're saying about the idea of parity. Bank of America forecasting the euro-US dollar to rise to 110 by year end, simply because there isn't going to be the same kind of inflation that comes with tariff in their mind. And frankly, the blowback on the U.S. economy is going to be more significant. Would you agree with that?
I don't think it's going to have a significant blowback on the U.S. economy. I think this is going to be more directed towards the FX market itself, where, again, you've heard other guests and you've heard the conversation around it. The dollar, a very strong dollar, is bad for the rest of the world. It's not great for Asia. It's not great for Europe. It's not great even for the U.S. I think a big piece of it here is, again, what is the North Star of Trump's economic policies? And again, while there's a lot of focus on tariffs and other things that are creating a lot of uncertainty, which is building into these risk premiums, I think the thing that Trump wants, and again, we're going to already start talking about the midterms, probably in 6 months, that'll be a key focus, is the U.S. trade deficit. You cannot eliminate the U.S. trade deficit with an overvalued dollar. So the more panic that the dollar creates, the more the dollar strengthens, the more the U.S. economy looks exceptional, the more you need to kind of have some kind of currency accord, the more you need to find a mechanism and a way to reduce the value of the dollar, which will require cooperation. So if the end game here is some kind of cooperation, and the means of getting there is the tariffs, is the uncertainty, is the unpredictability to kind of get to that place where you want to create a bargain, that's where you could go in 6 months where you get a weaker dollar.
Hold on a second. Mark, I'm just thinking about the Mar-a-Lago Accord that you're basically talking about. What are the contours of this thing?
Well, I think a piece of it, right, is what's going on with U.S. and China. How do you basically get to a point where you allow U.S. and China to coordinate a much stronger renminbi? Of all the valuation models we track, the Asian currencies are the most undervalued. The yen, the Korean won, the Chinese renminbi should be extremely stronger. So if you want to find a way to eliminate the strength of the U.S. dollar, you can create an accord where it say, hey, we'll give up some access to the U.S., maybe a BYD factory. They're under the guise of Tesla. And again, with that, you get a much stronger Chinese renminbi. So with those type of environments, what you could see is to reindustrialize the U.S. and reduce the trade deficit, and to have that work where the U.S. is a bigger exporter, you need to find a way to weaken the dollar. So those would be situations that could reinforce a weaker dollar without even looking for the U.S. to go sideways. I think those are the kind of things you're going to see in the currency market that will actually change the outlook for the dollar, not kind of the U.S. economy moving sideways or the rest of the world catching up.
Mark, I imagine we'd have to see a whole lot more dollar strength before we got to that point. How much more dollar strength?
Well, if you think about it, dollar's almost close to record highs. So we're looking for the BDXY, the Bloomberg Dollar Index, to revisit 1350. That is, sub parity for euro. That is sterling below 120. We don't think this is going to feed directly into dollar China. We do think they're going to try to hold on to that a little bit. They can use swaps, like they can direct banks to use swaps. They can use the fixings, but that means Korea is going to weaken. Dollar CAD is going to strengthen. Mexican peso is going to hit new lows. So this is a broad dollar move. So I think, again, if we add from where we started last year, again, because most of the context around the dollar last year is everyone was very bearish on it. And that changed quite dramatically. So again, I think if you take the combination of the move from Q4, you extend that, you get the BDXY at around 1350. We are in a situation where the world feels, very uncomfortable with the level of the dollar strength at that point.
Interesting. Mark, fascinating stuff. Appreciate your time, sir. Mark McCormick there of TD on the FX market and the potential for a Mar-a-Lago Accord.
Essentially, it's going to become so punitive. They have to all get together in the sunshine of Florida, South Florida.
Trump has been complaining about excessive dollar strength for a while because he's concerned about the fact that this can hurt export competitiveness and the manufacturing base in the United States.
And then embracing policies that lead to further dollar strength. So something's got to give. Up next on the programme, Chris Harvey of Wells Fargo, Jon Schneyer of CoreLogic, Michelle Meyer of the Mastercard Economics Institute, and Michael Nathanson of MoffettNathanson on the latest moves by Mark Zuckerberg over at Meta. The second hour of Bloomberg Surveillance up next.
We've seen equity be able to perform despite the fact that you've seen a pickup in long end yields because the growth picture has been strong.
The U.S. has a particularly good spot.
We're likely to see many pockets of volatility brought on by this drip feed of tariff news.
You can have a real kind of protracted pullback.
That is basically the story for the 2025 outlooks, is uncertainty and unforecastability.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
If you're bullish, stay in bed. We're down again. by 0.75% on the S&P. On the Nasdaq, down by more than 1%. Similar move on the Russell as well. In the bond market, no help or assistance coming from fixed income this morning. Yields up again for a 7th consecutive session on a 10-year yield. Fixed income just pushing higher and pushing higher on the yield side of things. Up 2 basis points to 4.78 on 10s. On 30s, had a little look at 5% in Friday's session. Yields are higher on the session this morning by a basis point to 4.96. And crude isn't helping either. Just the wrong time for a rally on Brent and WTI. Brent crude up by 1.7, WTI up by 2%.
And this goes to Stuart Kaiser's point. Are we seeing rates rise for the good reasons of growth, or are we seeing it for the bad reasons, which is inflation without growth? And really, the oil story speaks to that. I will just say Max Kettner of HSBC talking that we're going deeper into this danger zone of rates going higher, and it could be protracted. But he sees it as a buying opportunity. So if you're bullish and you're in bed, you can get out of bed and start to look at what your list is of buying opportunities, according to Max Kettner. Look at me being bullish.
All of this, though, just shows and goes back to you, Mitch, even though I know colored heavily on politics, that there is concerns amongst the consumer and inflation. Then you look at the price of oil, and you have to think at some point that might trickle down to fuel, especially what's going on in places like California. We could potentially see a very tight commodities market, and that's not going to bode well for this Fed.
I don't know about you, but I don't need much of an excuse to stay in bed at the moment, given how cold it is.
Okay,
so,
cold.
I don't think the market really matters too much.
Well, the fact that we wake up at 3,
it's something
like the fact that it's dark out. I mean, come on. Okay,
I considered 3:30 this morning.
Yeah, doom, gloom, morning.
Let's really push things.
Which you didn't actually, right?
Let's really push things. Of course I did. No, I woke up. I'm committed to the program and all of you. Your week ahead looks like this: CPI, PPI, retail sales on the economic side of things, and we've got some earnings too. Check out Wednesday. Look at this: JP Morgan, Citi, Wells Fargo, Goldman, all reporting. Then on to Thursday. Bank of America and Morgan Stanley.
What I want to hear from some of the bank earnings, not only about what they think about M&A, what they think about some of the deals that could be on the table and just how fruitful those pipelines are, but consumers and consumer confidence, and not just for people who have credit ratings above 800, but the idea of more broadly, how much confidence does each household have at a time where Torsten Slok just sent another missive talking about how households are in incredible shape. So do we get that kind of ratification also from the big banks?
How dependent is the outlook on the incoming administration? I imagine we'll get some commentary on that on a calls in a few days' time.
And also on Thursday, Scott Bessent, the designate for Treasury Secretary, will have his hearing. That's going to be very interesting, and I think the market will be paying attention to what he has to say about what's going on with bond yields, about the dollar, and maybe about sequencing of enacting Trump's agenda.
Stay tuned for all of that. Stay tuned for this as well. Coming up this hour, Chris Harvey of Wells Fargo, as stocks sink on the back of a blowout jobs report. Alex De Silva of AccuWeather, with winds set to increase extreme fire risk around Los Angeles. And Michael Nathanson of MoffettNathanson on huge changes over at Meta. We begin this hour with stocks lower, the S&P 500 on a 2-week losing streak as traders continue to dial back rate cut bets. Chris Harvey of Wells Fargo saying investors are staring at a wall of worry, driven by the 100 basis point rise in 10-year yields since September. Expect lower rates through higher rates. Ultimately, we expect higher yields to be self-correcting. Chris joins us now for more. Chris, good morning. Good to see you.
Good morning.
Self-limiting, that's a phrase, self-correcting, that we've been exploring over the past week or so. Some people think we're already there. Do you think we need to inflict a little bit more damage before we see things turn the other way?
I think so. The move has been so sharp, people just don't step in and say, okay, now's the time. They wait for things to consolidate. You know, portfolios don't look that great, risk doesn't look that great, and so they're going to see, okay, we have CPI, let's get through CPI, and then let's decide after that. So we're getting there, but I think we still have some more upside.
Speed matters, size matters. It's 100 basis points since September on a 10-year yield. Does the why matter? What's behind the more recent move? What is this, inflation, growth? What is it?
Yeah, if you talk to 10 different people, you get 10 different answers. What we think is it's really driven about the Fed and about growth, right? If you look at what's really driven nominals, it's been more or less, in the 10-year, it's been more or less real rates. Inflation expectations have been relatively well behaved, but they are pushing up against 2.5%, which we think is reasonable. We don't see inflation accelerating from here like other people. And so when you look at that, you say, okay, we're getting to a level that we think people will start to step in, but the technicals are telling you, hey, wait a little bit, there could be more upside, or there could be more upside to yield.
There could be basically a better entry point. Things could sell off a little bit more. You did wake up today. You got out of bed. You came here. I just want to say thank you. And you actually are doing what we were talking about, which is looking at the potential entry points. Right. Not maybe yet, but down the line. What exactly are you looking at to understand that?
So what are we arguing about? If I'm right, it really is about growth. Well, if the economy's strong, shouldn't that be good for earnings? And if so, maybe earnings start to, help stabilize things. The other thing is, at some point, do the bond buyers start to step in? And if they do, okay, great. The other thing that we're talking about is who's going to be head of the Treasury. It looks like Scott's going to be appointed, right? There's a big talk about, hey, we could have a Liz Truss moment. Well, his experience and his influence should minimize that probability, okay? What are we looking at with regard to inflation? Well, inflation expectations already at 2.5%. Where do you think they're going to go from there? And is the economy accelerating from here? Because I think inflation is going to be demand-driven. I just don't see enough demand. The last thing I would say is one of the things that we're looking at is how the market reacts to price versus unit volume growth, right? And one of the things we were always talking about is, it's about supply and demand. Well, what we're seeing during earnings season, what we saw during earnings season, is the market is rewarding unit volume growth over price, and if that continues, that could cause a reaction function to really limit inflation.
A lot of people are worried less about Liz Truss moment, and they do have confidence about the Scott Bessents of the world, maybe tamping down that possibility, and more worried about the strong dollar impeding earnings.
Yeah.
How much are you looking at something that Mike Wilson really laid out over the weekend, which is that international companies are going to see a much bigger hit, and domestically oriented companies are going to do a lot better on a relative basis?
We're not looking at that so much for idiosyncratic reasons. What we're looking at that is that's a big risk factor. If you go back to the summertime, August, you saw what the yen did. If you go back to September of 2022, you saw what the pound did. If you look at the euro and the pound right now, they don't look too healthy. And typically when you see these currencies slide like that, that's a big risk factor, and that could start to weigh on the markets. Yeah, can it affect some idiosyncratic stocks and some stock stories? Sure. But we're worried more about the macro side because things are really starting to slide pretty quickly.
Do you think there's a line in the sand for the incoming administration?
When it comes
to how high the dollar, they'd want to see it go?
Well, they've indicated to some degree the Trump administration would like to see, my best understanding, they'd like to see a lower dollar, but that's going to be really hard in this environment. Where you do it, how you do that, it's not really clear to me, especially if the Fed's slowing down, the economy's stronger, and the rest of the world has a little bit more stress than we do.
The economy's stronger, yet they're looking to potentially spend a lot more. I spoke to the former Speaker of the House last week, Kevin McCarthy, and he said the market's going to have a voice, right. But then really didn't know exactly how big that voice would be when it comes to deficit spending and pushing back on how much this reconciliation package could be. Do you have a sense of what the market can handle?
I don't, but the one thing I will say is that we really need to take control. We really need to moderate healthcare spending. And until you moderate healthcare spending or the growth in healthcare spending, you can't get the deficit under control.
You mean entitlements?
Entitlements. But it's really within entitlements. It's more so healthcare than Social Security.
Just getting some news I wanted to bring to you. It comes from Macy's. They're trimming their outlook. The holidays clearly did not deliver, and the stock is getting hit in the pre-market. I think we're down by something like 4%, Lisa, at the moment.
Yeah, forecasting net sales at or slightly below $7.8 billion to $8 billion, basically saying, as you said, disappointing holiday season. Also, the idea of improving 50 stores to an additional 75 locations. I'm trying to understand what this means because it's talking about hiring more staff at a time where they also are closing other locations. So you wonder about the experience and how they transform what some people have experienced when they go there, which is different.
Sounds very personal, somewhat diplomatic. The stock is down by about 2, just to bring you an update on the stock price. Get some more earnings through the week. We mentioned the banks, of course. On Wednesday, you're going to hear from a ton. JP Morgan, Citi, Wells Fargo, and Goldman Sachs. Can we continue to maintain the faith in the financials? Nothing was spared from the sell-off on Friday, with the exception of energy, given the rally in crude again this morning. Can we continue to maintain the faith in financials?
I think so. Does that mean that they'll trade better on Friday? I don't know, right? But if you look at what the reasons why we like financials, especially banks, we still believe there's going to be multiple expansion. We still believe there's upward positive EPS revisions. We haven't even seen, right? We're talking about deregulation or lighter regulation. You're seeing the changes at a lot of the heads, but you really haven't seen things come into effect. And so we're sitting on a situation that we haven't seen in over 15 years.
Lisa alluded to this earlier in the program. Do you get a decent read on the consumer from these large financials, given that many of them serve a pretty high-end client?
Yeah, I think you'll get a decent read. And they've talked about low end, they've talked about high end. I think that the consumer is okay. Right? They're not great, they're just okay. And what we have to worry about with the consumer at this point in time is what is their psychology, right? How do they feel about things? And we've had some reports on inflation and inflation expectations, which weren't great. And if that continues, that could cause the consumer to pull back a little bit, and that is a concern.
I'm looking at the consumer's appetite right now, and it's for Blue Mercury. It's also for high-end handbags and shoes, as you deal with some of these different types of customers who go to department stores. And it sort of speaks to how much different industries are transforming right now. Yeah. How much dispersion is there right now at a time where you have those that are performing well and adapting quickly, and those that are falling off the map?
I think there's a ton of dispersion. I think if you're still selling to the high end, that's great. What we do know is services still very strong. But if you have run-of-the-mill type stuff, unless you're Walmart or Costco, it's hard to push that, right? And Walmart and Costco are really taking a ton of market share, which is putting a ton of stress on other retailers.
Let us know how bonus season goes later this week, will it? All right? Chris, it's good to see you. I'm not going to go there. I kind of went there, but I'm not going.
You totally did go there.
Chris Harvey of Wells Fargo. Have you seen some of the numbers we're talking about?
I know.
10% plus across the street.
Although I imagine some places more than others. I saw Deutsche Bank coming out. Pretty big bonus season. JP Morgan. Yeah, pretty much across the board.
I may say well earned as well, Chris. Equity futures right now in the S&P, negative by 0.9% with an update on stories elsewhere this morning. Let's get your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. The Los Angeles wildfires are on track to be the costliest in U.S. history. AccuWeather has raised its estimate for total economic losses to between $250 and $275 billion. FEMA Administrator Diane Criswell says that things will need to change when it comes to rebuilding. California Governor Gavin Newsom issued an executive order suspending some environmental and regulatory hurdles to speed up the rebuild. Korea's transport ministry says the black boxes pulled from a Jeju Air jet that crashed in late December stopped recording in the final moments before impact. A joint team of Korean and U.S. officials are trying to find out why the devices stopped working in the final 4 minutes of the flight. The crash killed 179 people in South Korea's worst aviation disaster. Macy's shares falling pre-market, as you all were mentioning, down 2 1/3%. The company issued a downbeat outlook for the sales in the current quarter, a sign that executives might have been too optimistic about expectations for a solid holiday shopping season. Comparable sales were roughly flat in the 9 weeks ended January 4th compared to the year before, but higher-end stores like Bloomingdale's and Blue Mercury reported positive comparable sales. And that's your brief. John.
Danny, thank you. Stock down about 3%. More updates on Macy's throughout this program this morning. Up next, LA wildfires igniting political tensions.
Right now, at least from the LAFD side, we're focused on two things: containing the fires and saving lives and protecting property. With the impending winds, we got to pay really, really close attention to this.
We'll bring you the latest up next on the program, live from New York City this morning. Good morning. Equity futures near session lows were negative 0.9% on the S&P 500. Yields pushing higher by 2 basis points, 4.78 on a 10-year, and crude up by close to 2% at the moment. WTI 78. Under surveillance this morning, LA wildfires igniting political tensions.
Right now, at least from the LAFD side, we're focused on two things: containing the fires and saving lives and protecting property. With the impending winds, we got to pay really, really close attention to this. This wind event is approaching us, and it's approaching us very, very quickly. Mayor Bass, Chief McDonald, myself, our city leaders are fully committed to ensure that we're ready for this next event.
So here's the latest this morning. Los Angeles bracing for multiple rounds of Santa Ana winds this week, set to cause further destruction as political infighting continues, with Governor Gavin Newsom and local leaders pointing fingers. This as President Biden pledges full federal aid over the next 180 days. President-elect Donald Trump taking office in just 1 week. Joining us now to discuss is Bloomberg's Tyler Kendall from the nation's capital. Tyler, how well aligned are leaders in Los Angeles at the moment with federal government?
Yeah, good morning, John. Well, President Biden today will convene senior administration officials for an update on the federal response in the state. We know that the Pentagon has deployed 500 troops on the ground, and California Governor Gavin Newsom confirms that at least 9 states, as well as Canada and Mexico, have also deployed resources there. So when it comes to federal and state government working together, they seem to be aligned in that case. But as you mentioned, President-elect Trump is going to take office in about a week, and we know that he has been invited to tour the devastation there. He's yet to publicly accept that invitation, although he is publicly criticizing the response in a post on Truth Social most recently. Yesterday, he called California officials, quote, incompetent. In response, Governor Newsom says he's used to President-elect Trump's insults and defended his own response. However, Newsom says he is asking questions of his local officials and has already directed the state to conduct an independent investigation when it comes to LA County's water supply, which has been a point of contention. John, at least one lawmaker has actually gone a step further. Newly minted California Senator Adam Schiff is calling for an independent commission to review the state's response to the crisis as a whole.
Tyler, overall, what is the future of disaster relief, especially in a place like California, where we know there's this tit for tat between President-elect Trump and Governor Gavin Newsom? What is it going to look like?
Well, Vice President-elect J.D. Vance over the weekend appeared to try to tamp down concerns that Trump would withhold aid, telling Fox News that Trump will be a president for, quote, all Americans. However, you have seen Governor Newsom, for example, point to past comments from the president-elect, most notably September 2024 at a press conference in Los Angeles, where Trump preemptively threatened to withhold wildfire aid if Newsom did not reverse course on some water regulations, most notably one that Trump would like to see divert more water to California farmers. However, I'm actually closely watching Congress on this one because, Anne-Marie, as you know, FEMA recently saw its disaster relief fund replenished in December, about $29 billion. But a chronic and also bipartisan concern is that FEMA is going through a backlog of cases and likely will not have enough money for these wildfires to cover it. That means that we're likely gearing up for additional supplemental disaster relief to be passed, likely in March when Congress considers the next government spending deadline. However, Anne-Marie, over the weekend, Senator John Barrasso, the number 2 Republican, told CBS News that that aid likely will come with, quote, strings attached. What that means, particularly for California policy, remains to be seen.
Tyler, I appreciate the update. Tyler Kendall from Washington, D.C. Let's continue the conversation. There are wide-ranging estimates emerging as analysts work to calculate the potential financial impact on real estate and insurance in Los Angeles. Jon Schneyer of CoreLogic, which produces data in response to catastrophic global events, joins us now for more. John, let's get into some of the data and whether you can tell at the moment or if it's too early, just what went wrong here.
Well, it's one of those things where because the fires are still spreading in containment, while increasing, fires are still not contained. Coming out with insured loss estimates or total economic loss estimates are always subject to change. One of the things we are sort of honing in on is that this is likely going to be, a $20 to $30 billion insured loss event. Definitely one of the most destructive wildfire events in the Los Angeles in history, maybe in California history.
John, this comes at a point when we've already had housing shortages in California, discussion around where people are going to live at a time where the average price in some of these areas was $3 million for homes. How do you rebuild in a place at a time when you have labor shortages, having in construction in particular, when you have insurance premia that are going to have to go through the roof, and you have real questions about what additional risks are going to be going forward?
It's a really good question. And when it comes to rebuilding, keeping this concept of, or this idea of mitigation in mind is really important, because what we saw in, if you look at historical examples like the Camp Fire in Paradise back in 2018, rebuilding an entire community with fire risk in mind can do wonders in terms of reducing wildfire risk and actually having a pretty serious reduction on wildfire insurance premium. Not just individual mitigation at the homeowner level, whether that be using a Class A roof, making sure there's no combustible structures attached to your primary home, but making sure that when you rebuild, keeping in mind natural fire breaks within the community and combining these individual mitigation and community level mitigation efforts can do wonders. It can reduce wildfire losses by 75% and could have a direct impact on insurance premiums as well for homeowners who can move back to the area.
The issue is, John, and we've seen this in other areas also, is that a lot of the models, whether it's fire risk or whether it's flood risk, are not updated. They are outdated. They don't necessarily reflect the entire risk zones. And it's more expensive to put certain measures in place that could mitigate the risks. How resistant are officials when you talk with them about planning ahead if it costs more, if it actually does take more resources at a time where their resources are strapped in other places?
It's a good question. And I think officials, regulatory officials, are more open to the idea of using these forward-looking models, the stochastic models, as opposed to being reliant entirely on historical loss experience. The models are updated frequently, annually, biannually, what have you, to account for increase in risk, whether that be due to the environment, for wildfires, for example, fuel layers, wind patterns, what have you, or for flood, just higher sea level, increased frequency of flooding events. The models are accounting for these changes, and the recent regulatory changes in California that were effective at the beginning of this year, right, allowing carriers to use stochastic models, forward-looking models, means that, and what we hope, and this is what we believe will be the case, is a more healthy insurance industry within the state. There will be more carriers to be able to provide more coverage at actuarially sound rates, so that in the event of another natural disaster event, there will be finances available for home and business owners to rebuild.
But, John, thousands of insurers chose not to renew home insurance policies of thousands of people. The former Speaker of the House is from California. He was telling me his mom just weeks ago lost her Geico insurance. What happens to those people?
Well, they end up going to the insurer of last resort. It's called the FAIR Plan in California. And we've seen recently that more and more homeowners and business owners have moved into the FAIR Plan. A similar phenomenon we saw in recent years with the Citizens Insurance Plan in Florida, when it comes to wind insurance. And as these state-backed insurance plans grow in terms of the number of policies they have in place, well, that means there's a lot more risk. There's a lot more risk sort of within their books. And a large natural disaster event, like what we're seeing in California now, could have a pretty serious impact to that state-backed, insurer of last resort. Now, in California, carriers who write in the state must participate in the FAIR Plan. If reserves, reinsurance, any sort of bonds, cap bonds that are in place are used up as a result of this event, the insurers will make up that difference so that all claims are paid. The downstream economic effects of that, how that applies to premiums or rates going forward, remains to be seen. But those claims will be paid, and people will be able to rebuild if they are part of the FAIR Plan.
John, I appreciate your input this morning and your time. Thank you, sir. Jon Schneyer there of CoreLogic. I think we all have a great amount of sympathy for emergency services in Los Angeles who are totally overwhelmed by all of this. The rebuild effort is going to be absolutely immense. And Governor Newsom, whose political future is very much on the line, understands that a lot of people are taking aim at democratic bureaucracy. And when he said this over the weekend, that when the fires are extinguished, victims who have lost their homes and businesses must be able to rebuild quickly and without roadblocks. That's the direction of travel now. They need to cut a lot of red tape to help the rebuild and help rebuild fast.
And there has to be a real assessment of what red tape needs to get cut. They also need to reassess exactly how to create a situation where structures are immunized from this type of spread of wildfire going forward. Look, there's going to be a lot of studies going forward. What I'm hoping is that we can strip out some of the politics of it and the D or the R next to whoever's name is where, and to really go toward what is the most efficient way to move forward.
And when it comes to stripping out some of those deregulations, it's going to be some of those environmental concerns California put up, and they're going to say, well, this takes too long to rebuild the home, and they're going to basically just let them go without using those concerns.
Up next on the programme, we'll continue this conversation. We'll catch up with Alex Da Silva of AccuWeather, with Los Angeles set to face further threats as the winds pick up. That conversation up next. Stocks down for a second consecutive week last week, and we're adding to those losses this morning, taking some more weight off the S&P. We're negative by 0.75%. On the Nasdaq 100, down by a little more than 1 full percentage point. With 2 hours until the opening bell, let's get you some morning movers and say good morning to Manus Cranny. Good morning, Manus.
Jonathan, a very good morning to you. Yeah, you're right. Look, Mag 7, long duration, all grappling with a full frontal assault from the bond market. And then you have news flow, which compounds on the downside. Apple has just had a quarter they would prefer to forget in terms of iPhone sales, down 5% globally. They're losing market share in a growth market. Why? because their AI product perhaps isn't as exacting as the market had wanted on iPhone 16. But you got to hand it to Mark Zuckerberg. Not only has he changed the look, the style, and the rhetoric, and really having a pop at everybody and repositioning himself. Steve Jobs invented the iPhone, and now they're just kind of sitting on it after 20 years. I mean, that podcast with Joe Rogan is certainly, there's some moments in that are certainly worth listening to. Roll it over, have a look at Tesla again within the family. There's a bit in an offer story here. On the offer side, you got one of Europe's largest pension funds. It's called Stitching Pension, ABP. They're dumping $500 million worth of stock. Why? Because they've got angst over the pay rise that Elon Musk gave himself. On the bid side, you've got Tesla actually doing better than Audi. Yes, all of them are under pressure. Porsche, maybe I'll get that second-hand Porsche, you never know, drive around the streets in New York. Porsche sales dropping in China, but Tesla is beating Audi. What do you want, a Tesla, an Audi, or a Porsche? Go figure. Let's roll it down and finish off with NVIDIA. The reason why I've pinned this one is a couple of things. One, the story that we put out last week, which was about the new regulation on high-end AI chips, comes into force today. So the official traffic light system comes in. If you're an ally, you're fine. Everybody else has got to get in line. But we're now very firmly in the correction zone. 3 sessions took us down by over 9%. If we open down by another 3%, obviously we're down 12% then. So this is about a stock which has now very firmly entered the correction zone. You're going to hear the clarion call of this is your opportunity. This is your golden opportunity on a correction to jump in. Dan Ives, where's the note? I think it's already out.
Appreciate your time, sir. Thank you. A Porsche. Just to throw that out there. All right, a Porsche. Make it easy. Under surveillance this morning, Apple's core business taking a hit at the end of 2024. Data from Counterpoint Research saying the tech giant sold 5% fewer iPhones globally, with Apple losing market share to Chinese rivals. One reason for the slowdown, Apple AI has been rolling out in stages and isn't yet available in China.
I'm curious how much this has to do with AI availability and sort of a disappointment that it hasn't been more bold or actually more available earlier. How much this is just the national champions in China with cheaper phones actually making inroads, because that is really what you have seen is essentially huge inroads being made by the likes of Huawei technology and Honor device, basically all Chinese companies. So that, I think, is probably a big part of this as well.
And if you buy some of those national champions and their phones, the actual AI agents, they're developing on their own and they're ready in the phones. You need to wait for this hodgepodge of approach if you buy the Apple phone.
You've got to wait until January 30th to get the official numbers. That's when we get earnings from Apple, and we'll see how they stack up with the numbers coming from Counterpoint Research. That stock is down by a little more than 1%. Elsewhere in Washington, a group of House Republicans saying their meeting with President-elect Donald Trump over the weekend was quite positive and productive. The GOP members from New York, New Jersey, California pushing for the $10,000 cap on the SALT tax deduction to be raised or eliminated.
Trump gave them a little bit of work to go back and do, though, basically saying, come back here, according to Mike Lawler of New York, who we actually spoke to last week as well, coming back and basically saying, well, I'm going to need a number. The line is in the sand, though, for these Republicans. I don't think they care so much about if it's one reconciliation package or two, but the fact of the matter is they need SALT included to get their sign-off. And this comes down to the fights that are going to be happening in the next few months when you have the slimmest Republican majority ever. Every single lawmaker on Capitol Hill is going to become king.
Biden had this headache through this administration, Manchin, Sinema in the Senate. Now there's a bunch of them in the House for Donald Trump to deal with.
Which is going to raise a question about how much they can actually cut, given that everybody wants a bone thrown at them, right? It's all the pork.
I was in Palm Beach this weekend. It wasn't just lawmakers from New York, from California that were going down there. You also had all the chairs of the committees from Congress. They are preparing to come in on day one and really already have a lot of these conversations out of the way. One thing I'm really keen to learn about is whether or not the debt ceiling gets put into reconciliation or not. I'm told, and what I'm hearing is that Trump wants it out. He wants these debts cleared as quickly as possible. You have to think, it's debt ceiling, it's spending, then it's reconciliation. It has potential to get messy.
Is that work or vacation, or a blend of the two?
I think it's bleisure.
Bleisure.
Yeah. Because
that's well,
I went there for work, but I did also get, some sun on Sunday morning at the Breakers. I think that's bleisure.
Blended.
So everyone going to Palm Beach now is just bleisure.
I think, honestly, I think it's everyone. I don't think it's the journalists.
It's leisure.
No, I get that bit.
Yeah.
Mark Zuckerberg. For me, though.
Mark Zuckerberg was there Friday evening at Mar-a-Lago, hanging out with Trump.
I'll break it down.
Appreciate the explanation.
I'll bring a slideshow.
Yeah. Just I'm keeping up, just about. Let's get the latest elsewhere. Some serious news. The National Weather Service issuing a so-called particularly dangerous situation alert. It's most severe for areas across Los Angeles, including Malibu and the San Fernando Valley. Los Angeles bracing for at least 2 rounds of powerful Santa Ana winds this week alone. A real fear this is going to spread and get worse.
This is devastating. I mean, when you really think about it, people in their homes not sure whether they're going to have to evacuate with go bags ready to get out of there because they might lose their homes and they know it's going to get worse. It is devastating to think. The area looks like it's been firebombed in areas. So you start to wonder, how do you move forward when we still aren't out of the heat of it? No pun intended, a really terrible situation there.
The cost is heading in the wrong direction. AccuWeather increasing its preliminary estimates of total damage and economic loss to a range of $250 to $275 billion as the fires enter their second week. Alex De Silva of AccuWeather joins us now for more. Alex, welcome back to the program. What's the latest?
Yeah, well, right now, the winds are starting to pick up in Southern California, but the good news is some of these fires have been contained a little bit more. The Kenneth Fire and the Hearst Fire are nearly 100% contained this morning. The Eaton Fire is now up to 27% contained, and the Palisades Fire, the biggest fire of them all, is now around 13% contained. Unfortunately, what do we have to look forward to over the next couple of days? More wind coming down into Southern California, big area of high pressure coming down into the Great Basin. This is going to increase the winds, unfortunately, from the northeast here over the next couple of days. We could be looking at 60 to 80 mile per hour winds in those very, very vulnerable areas there, just north of the Los Angeles metro area. This is the area I'm most concerned about. I don't think it's going to be the strength of the last event that we saw, but we could still see wind gusts even up to hurricane force.
Alex, appreciate your time, sir. Alex De Silva there of AccuWeather. Alex, thank you. Let's turn to the economy and think about the impact of all of this. We get some data this week. CPI on Wednesday, PPI before that, retail sales after that. But in a couple of months' time, you're going to see a huge disruption in this economic data. To talk about all of this, joining us now is Michelle Meyer of the Mastercard Economics Institute. Michelle, good morning. It's good to see you.
Good to see you. Good to be here.
Great to catch up with you as always. How disruptive will this data be in the months to come off the back of these fires?
Well, of course, I mean, that's probably one of the littlest things that we think about when considering the wildfires right now and the devastation that's having on people and families and livelihoods. But of course, as economists, and we're trying to understand what's happening in the economy and the markets, the high frequency data matters a lot, and it will be noisy in the coming months. So you're going to see a lot of people trying to X out the impact of California to the extent that that's possible. So a lot of that conversation, without the disruption, it would have been.
It, though, raises some issues, some nodes of pressure that we have, in particular in the housing market. The idea that they're going to have to rebuild at a time where housing shortages already were pretty prevalent in the area. How much room, how much slack is there in the economy to compensate for building, to compensate for some of these things at a time when some people say it's a pretty finely balanced labor market?
Well, of course, I mean, you have to think about the inputs into the equation for rebuilding in terms of the raw materials, the labor, just the capacity to be able to add that much housing stock as quickly as it needs to be added. But that said, we also should be seeing a lot of stimulus into the area, hopefully, which should help encourage and speed up that rebuilding process. But it's going to take time. The devastation is tremendous.
And it still hasn't ended, as we were just talking about. Broadening out, there's a larger question about just where we are and how real the numbers were on Friday, how good they actually were versus maybe overstating things with the preliminary read that wasn't necessarily verified in other data. From what you're seeing, from the Mastercard expenditures, from all of the secondary and tertiary data, do you think that this truly is a labor market that has more upside surprise than people are giving it credit for?
I do. I mean, as you know, at the Economics Institute, we've been very positive on the trajectory of the economy this whole cycle. And a lot of that is because of this ability of the consumer to spend, which represents a positive feedback loop with the labor market. So any given jobs number, we know, subject to revision. You have to look at a moving average. You don't want to overemphasize one report. But if you do look at a moving average and you think about what's happened in terms of the last several months, it has still been strong job creation, an unemployment rate that is remaining sticky low, and measures of unemployment insurance when you look at jobless claims that are still very, very low. So the labor market is supportive. Wage growth is continuing to run at a solid pace above the underlying pace of inflation for goods and services, and that's supporting consumer spending. As consumers spend, that then further drives this feedback look back into the labor market. So on Friday's jobs numbers, we had very strong hiring in the retail sector, for example. Part of that was seasonality. November was weaker, December stronger, but nonetheless, that does represent a fact that consumers are engaging.
When it comes to, though, that concern about inflation, I know it's colored with politics, but University of Michigan is showing that actually consumers are concerned about inflation going forward. Is that driven because of talk of tariffs and policy, or is that just driven by they're still not comfortable with the price level they've seen over the course of the past 2 years?
I think expectations are still resetting to that price level, right? When you talk to an average person out there, they're saying, but it used to be so much less expensive to buy this. And that less expensive might have been a week ago, a year ago, or 5 years ago, depending on when they've last purchased the item. So I do think expectations are still resetting. It depends on the product, right? When you think about groceries, for example, over the last year and a half now, we've been in very steady and low inflation, between 1% and 1.5% for grocery inflation. So for food, you're starting to get consumers to feel more comfortable that this is probably the price that is sticking, and it makes sense. They're not continuously seeing price increases. But there is a little bit of a discomfort, of course, amongst consumers after seeing such a big price level increase. That said, if you look at long-run inflation expectations from the University of Michigan, this whole cycle, they've actually been pretty well contained overall. So over the longer term, I think consumers still have a more disinflationary psychology that is sticking.
How do you think the economy will deal with potentially broad-based tariffs of the incoming administration?
So it depends, as you know, how you define broad-based tariffs. So there's so much uncertainty in terms of what the policy will actually end up being, and we'll adapt our views as we learn more. But I think in general, what we've seen in the past with tariffs is that it does prove to be somewhat of a temporary price level increase on those products that are impacted by tariffs. And then it could also just change in general the cost of production, going back to the conversation with Lisa before around the cost of rebuilding and housing construction. Input costs matter in every way, of course, across the economy.
Is it leading to any pull forward from the data you've seen? People buying durable goods? Any of that at all?
You know, it's really hard to ascertain whether or not that's happening. You do hear it and see it more visibly in terms of companies stockpiling and trying to make sure that they're importing as much as they can, particularly from areas that might be targeted in terms of tariffs. But for the consumer, that's something that's really hard to determine whether it's a pull forward or it's just an acceleration of spend.
Michelle, appreciate your time as always.
You got it.
Thank you. Thank you very much. Michelle Meyer of the Mastercard Economics Institute. On the Federal Reserve front, the last week of Fed speak before the blackout period, you will hear from the New York Fed President John Williams a couple of times this week. Look out for tomorrow, I believe 3:05 p.m. Eastern Time. Very precise for the New York Fed. Some opening remarks.
So have we learned who some or the number
Not yet.
of members? I wonder if anyone's going to stand up and said, I was the one. I was the number. I was the person who decided to take into account some of the potential policies.
You've identified one Fed official who might be in the running to become the next Fed chair.
We have.
Who's put themselves in the running.
You're talking about Chris Waller.
Talking about Governor Waller.
Yes,
with that address from last week.
It's not inflationary tariffs. Just ignore that completely.
Neil Dutta of Renmac taking that side of things as well. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Already some Fed speak from former Federal Reserve Vice Chair Randall Quarles, who doesn't think that the central bank's independence will be in jeopardy once President-elect Donald Trump takes office.
Structurally, the Fed can't really be affected by the president's bully pulpit. And, the people who are appointed to the Fed generally have fairly thick skins. So while there's certainly political pressure, there's not really political levers that someone can pull to affect their independence.
He also said Trump's planned tariffs shouldn't be inflationary, but at the margin could convince the Fed to lower rates. OpenAI's top executives are planning to host events in Washington, D.C. and key swing states to promote investment in AI. The company has released a new economic blueprint for AI, calling for public and private sectors to work together in areas like energy and infrastructure to keep the U.S. ahead of China. OpenAI plans to hold events in Pennsylvania, North Carolina, and Alabama to announce new AI projects as part of its efforts to boost economic activity. The NFL playoffs are in full swing with the wildcard weekend kicking off in a 5-game slate. The Houston Texans upset the LA Chargers after QB Justin Herbert threw 4 interceptions. Buffalo took care of Denver in a dominating 31-7 win. The Steelers fell to the Baltimore Ravens in their 5th straight loss. Green Bay came up short against Philly, and it is jubilation in the Beltway after the Commanders beat the Bucs to win their first playoff game since 2005 behind rookie QB Jaden Daniels. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes. Up next on the program, turning the page on DEI.
The kind of masculine energy, I think, is good. I think corporate culture was really like trying to get away from it. Having a culture that like celebrates the aggression a bit more has its own merits.
Just for the record, Lisa, far more aggressive than I am. Every single meeting we have.
It's probably true.
That conversation is not next. From New York City, this is Bloomberg. Things recovering just a little bit. Stocks down by just 0.6% on the S&P. Bond market pretty stable. Crude still rallying. We're up by more than 2% on WTI, but the 10-year's hanging in there now, just about unchanged, 476.55. Under surveillance this morning, the focus very much on Meta, turning the page on DEI.
The kind of masculine energy, I think, is good. And obviously, society has plenty of that, but I think corporate culture was really like trying to get away from it. And I do think that there's just something, it's like, I don't know, all these forms of energy are good. And I think having a culture that like celebrates the aggression a bit more has its own merits. It's one thing to say we want to be kind of like welcoming and make a good environment for everyone. And I think it's another to basically say that masculinity is bad.
There's a lot to cover here, so here's some of the latest. Sweeping policy changes at Meta, with the tech giant becoming the latest company to kill its DEI programs, days after overhauling its content moderation. The CEO, Mark Zuckerberg, blasting the Biden administration for putting pressure on its platforms and saying he's optimistic about Donald Trump's return to the White House. Joining us now to discuss is Michael Nathanson of MoffettNathanson. Michael, where do we begin? So let's start here. The advertisers. Mark Zuckerberg is not a leader here, he's a follower, and he is following Elon Musk. What do you think happens next with the advertisers on Meta's platforms?
Okay, good morning, by the way, and thank you for that lead-in. So here's what I think happens. The core of Meta's advertising are small and medium businesses that are buying performance advertising. They're not brand advertisers, right? Brand advertisers get very skittish when they're in content that's not brand safe. Most of Twitter's X's business at the point of the purchase were brands. Brands ran away from that platform. But at Meta, they're there to sell things, to drive traffic. They have very different types of rationales to be there. And I don't think it's going to be that much of a deal for, in terms of changing their reason to be there. They're there for performance marketing, and that's only gotten better through AI the past 3 or 4 years. So it's interesting. There's a lot of noise about what's it going to mean to his core business on the ad side. It's actually probably a non-event, right? It's just a lot of noise, but it's not going to change anything.
Well, Michael, let's build on that. Maybe it won't be bad. Perhaps it could be good. Let's talk about that a little bit more. Engagement. If you strip out liberal influence, if you reduce censorship, do you think that engagement can increase? And can I ask you this as well? Two-part question. Do you think that's what this is really about, or is it just about keeping the incoming administration off his back?
I think he's realized. So let's go to the second question first. I think he's realized, big picture, that he was the only person, the only company really trying to play to the rules that he thought were going to come out of DC. But in that nuance, this is good for Meta, right? He's going to reduce his content moderation cost. To your point, he's going to open up his platform to people who thought it was biased. It's not going to affect his advertising. In terms of your first question about engagement, yeah, it's very possible that you're going to see a subset of consumers actually find more content they'd like on Meta than they did before. So from a business standpoint, It's a massive win-win. It really is. And then you haven't asked me yet, but if TikTok gets banned, having the administration not consider you an enemy of the people will help if the government decides to challenge or not challenge whatever the Supreme Court decides next week, right? So it's a win-win on all the business quadrants that you would care about.
Let's take that a step further, Michael. Does it increase the chances that Meta could purchase the U.S. business of TikTok?
I can't, at least that is one step too far. That to me would fly in the face of antitrust law, right? But if the government doesn't want to sell TikTok, it means that the winding down TikTok is just a massive win for these guys. But I don't know how a government would allow that to happen. They are their biggest challenger. It's just too big.
Well, the issue is that TikTok is just so expensive. So the individuals that can purchase it, they're all going to be up against antitrust laws. Is there someone, a company, an entity that you think could actually buy TikTok?
You know, Oracle was rumored in the past, right? So maybe Larry Ellison comes in with Oracle and makes a play for it. You could certainly see there's a couple private equity offers to happen. But the reality is, to your point, without Google's ability to buy it or Twitter, maybe X would make a move for it. But the Alphabet, Meta can't do it. Perhaps Microsoft would look at it. I mean, it's a really valuable asset, and we'll see if the Chinese are willing to sell it. But to your point, it will not be a frothy auction because two of the biggest competitors will not be allowed to bid for it.
Michael, this is a massive vibe shift taking place in corporate America. And I think it's quite something to see a CEO of one of the biggest companies in this country go on Rogan in the way he did and say the things he did about someone who's still in power, the sitting president. Do you think this kind of behavior from Mark Zuckerberg opens the door for other CEOs to follow and actually start saying what they really think about what's going on in Washington?
To a point, Jonathan, because I think people will be afraid to attack Trump given the fear of retribution for the next 4 years. I think this is a special case because this has been an issue for Meta since 2016. The question about how do you want to moderate content, and they're looking for the government for answers, and the government never came up with a plan. I think this is a specific case because I think it really challenged Mark's personal beliefs about what he should be doing. I don't see it that way. I don't think the next 4 years people will be going out and attacking Trump's policies. Perhaps some will challenge Biden, but I think this is such a unique case and playing to the strengths of Meta and Zuckerberg's, like where he stands right now, right? And also, you have Elon Musk at the hip to Trump, and this is a chance for Zuckerberg to kind of open up some opportunity here to get his thoughts across, because it's been dominated by Elon Musk the past 90 days.
Michael, appreciate your time, as always. Watch this space. There's so much to talk about here. Thank you, sir. Michael Nathanson there of MoffettNathanson, the latest on Meta. A lot of positives here in this shift from Mark Zuckerberg, according to the team over at MoffettNathanson. Look, the fear of retribution from the incoming president, I think, has been well covered. There's a whole industry dedicated to covering that story. Haven't covered enough the fear of retribution from the sitting president, Joe Biden, the Democratic Party. Only scratching the surface on that, and we've seen it from Mark Zuckerberg going into the weekend.
Although I wonder, to the point there, Michael's point, is this a specific case, a very specific person?
It's highly unique. Let's put it that way. TikTok, think it opens the door?
I mean, he just basically poured a lot of cold water on that, so I'm not about to sit here and say yes.
From New York City, the third hour of Bloomberg Surveillance. Up next.
Been a rally in bond yields around the world.
The bond market is a little bit on a knife's edge here.
I don't think we want to push our luck on yields much higher from here.
Yields have got to stabilize. Otherwise, you risk triggering these dynamics that can really hurt.
Hopefully we see the sell-off in U.S. rates that we've seen. Hopefully that calms down. I don't think it will.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
So much masculine energy. Overwhelming. Equity futures on the S&P down by 0.7%. On the Nasdaq, we're down by 0.9%. A massive week ahead for you. Kicking off with the economic data, we've got CPI, PPI, retail sales, all of that, and some bank earnings as well. What a busy morning Wednesday's going to be. JP Morgan, Citi, Wells Fargo, Goldman reporting earnings.
Yeah, and that's going to really take center stage in parallel with CPI, which has the potential to edify what we saw on Friday. If you hear the message from banks, consumers are strong, people are spending, the capital markets are open, and regardless of what happens with policy uncertainty, companies are ready to do deals, and you get a hot CPI print. Watch out below when it comes to sort of bond prices. Yields will continue to climb.
It's arguably the favorite sector of Wall Street. On the S&P 500 coming into 2025, we'll see if the numbers and the outlook justify it. Throwing this into the mix as well, this move in crude. WTI and Brent. Brent crude up by 1.6 through 81. WTI up by 1.9 through 78. Crude rallying.
Boldest action we've seen yet from the Biden administration in their final weeks, final days in office, really going after Russian crude in a more material way than we've seen during this entire crisis. And then I think you add to that, many people talk about maybe we're going to see a glut in 2025. Then you add to that, what's on the horizon when you think of risk premium? Well, potentially a maximum pressure campaign when it comes to Tehran. From President-elect Donald Trump going back to the playbook that he's likely going to use again. He is going to enforce those sanctions on Russian crude. So that is why you're seeing this tight market. And that is why you're seeing the equity market pull back as well. This equity market does not fear economic growth. It fears the possibility that we see a re-acceleration of inflation alongside that economic growth.
Especially at a time where a lot of people don't have faith in that economic growth. Let's be honest. How many people trying to poke holes in the data that we got on Friday, talk about the weakness, the stagnancy, the idea that maybe if you get that stronger dollar, it's going to really impede on some of the earnings power, particularly of international companies. So people are more concerned about the risk premia, the idea of something else, deficit concerns, the idea of inflation, these other issues that will cause yields to rise without the commensurate growth.
Quote of the weekend, Peter Chair, you'll like this one. What if markets reacted so poorly because no one believes the data, but everyone believes that the Fed will need to react to the data?
It speaks to the overly data-dependent, data point dependency of the Federal Reserve, and it goes to something we were talking about a lot last week, which is that the Fed might be the ultimate risk factor in the room, because what happened back in 2018 was not the policies of the Trump administration. It was the Fed's reaction to some of these things and the fact that they raised rates. And that, I think, is what a lot of people are going to be focused on.
Look out for the Fed speak through this week, the last week of Fed speak before the quiet period kicks in over the weekend. John Williams of the New York Fed will be speaking a couple of times, kicking off tomorrow afternoon. Equity futures right now on the S&P, just off session lows. We're negative by close to 0.7%. Coming up this hour, we'll catch up with Sam Stovall of CFRA with stocks lower to start the week. Chris Marinac of Janney Montgomery Scott looking ahead to big bank earnings, and why Veronica Clark of Citi is still expecting 125 basis points of rate cuts this year. We begin this hour with stocks lower, building on the S&P 500's worst day since December's hawkish Fed meeting, as a blowout jobs report puts rate cut bets firmly on hold. Sam Stovall of CFRA seeing trouble ahead. As a result of Friday's hot December jobs report, investors now worry that the number of rate cuts this year may be reduced to only one, if not none. In response, the United States equity markets have resumed their downtrends and are likely to face additional challenges. Sam joins us now for more. Sam, welcome to the show, sir. Let's talk about those additional challenges. Where do those challenges come from?
Good morning, Jonathan. Well, interesting. I was eavesdropping with your conversation with Lisa just a second ago and really trying to figure out what is it that's causing the yields to move higher. And it reminds me of the Chicago song, Does Anybody Really Know What Time It Is? So I think really the question is, how far does the 10-year yield rise? Is it 5%? Is it 5.25%? Or the long-term average of 5.75%? We don't think it'll be going up that high, but I think in the near term, while we wait the PPI tomorrow, CPI on Wednesday, and PCE at the end of the month, all three are expected to show flat to higher readings, and I think that could add to the overall agita.
Sam, 60 minutes ago, we caught up with Chris Harvey of Wells Fargo. Chris made an argument we've heard a few times on this program, that to get lower yields, you need higher yields, that this is self-correcting. We've heard others call it self-limiting. Do you think we're already in that zone where this becomes self-correcting, self-limiting? It puts pressure on the economy, puts pressure on equity markets, risk assets, and you'll start to fall back again?
Well, I think it's being self-correcting in terms of the market action itself. I like to take a look at the percentage of the sub-industries in the S&P 1500 that are trading above both their 50 and 200-day moving averages. And right now, we are only at 10%, which is very close to the longer-term oversold level that I like to look at. And so I'm expecting us to see a bit of a bounce back today, as well as possibly early in this week, but probably a retest as we move later in this week and into next week. I think also that investors will be calming down as it relates to the 10-year yield, because I believe that forward inflation readings will reassert the downward trend line. And so I think investors will be able to breathe a sigh of relief once again.
Sam, I want to go back to nobody knows what time it is, because that's sort of what this conversation also is reminding me of. Urian Timmer of Fidelity wrote this over the weekend. The earnings growth will ultimately carry the day and push the market higher, but these rate tantrums are a reminder that it doesn't take much to disrupt the market's mojo when valuations are high. You were just talking about the idea of oversold within the index. So which is it? Are valuations high, or are there sectors that are deeply oversold?
The answer is yes. It depends on the timing that you're looking at. In the near term, I think that we could see a counter trend rally because of being oversold. But I believe that we are going to need to see the yield on the 10-year note come back down again in order to maintain the upward trajectory in equity prices, because the valuations are high. Right now, the S&P is trading at a 20% premium to its just 10-year average forward PE ratio, and more than 35% on the 20-year, and technology is close to 65% based on its 20-year. So I think valuations show a market that is priced to perfection, and so I don't think we can see for a longer period of time an elevated level of 10-year yields.
Going forward, do we see banks priced to perfection at a time where we're expecting to see J.P. Morgan kick off the unofficial earnings season, even though Delta did it on Friday? But I'm just wondering, do you expect that to also prove to be overbought or oversold?
No, I think that the financials are going to be setting a positive tone. Remember that in 60 of the last 62 quarters, actual results have exceeded end of quarter estimates. So proving again that management does a very good job of managing expectations. We're looking for a 38% year-on-year rise in diversified bank earnings, looking for 43% gain in consumer finance, and a 45% increase in investment banking and brokerage. So our belief is that we're likely to be pleased quite a bit from the start of the earnings reporting period from financials in general and from the banks in particular.
I wanted to ask you and go back to that idea of the 10-year yield heading lower. You say once things start to calm down when it comes to jobs and inflation. But when you look at what's going to happen now in Washington, there's a debt ceiling debate. They still have to deal with 2025 fiscal spending before March, before they even get to this idea of reconciliation. Why do you think the 10-year yield will be calm during all of that?
Good morning, Anne-Marie. Well, I think that I wouldn't necessarily say calm, but I do believe that it will probably look to reassert its downward trend, mainly because I think that we are going to be seeing a decline in GDP growth from the 2.8% that we forecast for 2024 down to a 2.5% level for 25 and a 2.2 level in 2026. Certainly, there are a lot of what ifs that are out there that could work against this, in terms of the tariffs being more than a negotiating ploy, elevating the SALT write-offs and what kind of an impact that would have on government revenues, et cetera. So there are a lot of things out there that I think are going to be adding to volatility overall and lead to a single-digit gain in the stock market for all of 2025. But I don't think that we're headed for a deep correction or a new bear market.
Well, I was in Palm Beach over the weekend, and it's not just Lisa now talking about this concern of a Liz Truss moment. Do you think that the bond market is going to have a seat at the table when it comes to policy in Washington?
Good question. I think that certainly that Washington, they ran on the platform of cutting expenses, reducing the overall debt level, et cetera. So I think that the electorate will be reminding those at the table that that's what they ran on, that's what they won for, and now that's what they have to carry through.
Sam Stovall of CFRA. Sam, appreciate your time, sir. Thank you very much. Looking ahead to a massive week with tons of economic data and bank earnings as well. I agree with Anne-Marie. It's an important question. Will this bond market get a seat at the table down in Washington, D.C. when they come together with their big number for tax cuts?
I guess it depends on what this bond market is saying and whether it's actually whipped itself up into enough of a frenzy to actually get some attention from Washington, D.C. That is sort of what people seem to tell us. It's sort of like, yeah, it depends.
It is getting attention. Over the weekend, Senator Vance, soon to be vice president, mentioned bond yields twice as his interview at Fox News, and the concern that you bring up all the time. So I don't know why you're shaking your head.
I'm shaking
about
my head.
paying off the interest payment on our debt. 1 to 1.5 trillion, 2025. Maya McGuineas is saying it's going to be more than 1 trillion again this year.
Because they mention it, but it doesn't have a seat at the table because it doesn't have a corrective mechanism. But you're right. People are mentioning it.
Can we just reduce the masculine energy around the table just a little bit? It's overwhelming me. It's absolutely
so
overwhelming.
Sorry. Good morning, John.
Oh, boy.
Let's get you an update on stories
Happy
elsewhere
New
this
Year.
morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Residents and firefighters in Southern California are bracing for at least 2 rounds of vicious dry Santa Ana winds early this week. The powerful gusts are expected to challenge crews struggling to contain 2 blazes, which have left at least 24 people dead and destroyed over 12,000 buildings. JP Morgan CEO Jamie Dimon says that if used properly, tariffs can help resolve the issues of unfair competition and national security. In an interview with CBC Sunday morning, he went on to say, like any tool, if it's misused, it can do damage too. President-elect Donald Trump has promised to add new tariff levies on imports from China, Canada, and Mexico when he takes office next week. Dimon said that he has not spoken with Trump about tariffs. Johnson & Johnson announced that it will buy Intra-Cellular Therapies, a biopharmaceutical company focused on the treatment of nervous system disorders. J&J will acquire all outstanding shares for $132 per share. That is a total equity value of $14.6 billion. The transaction is expected to close later this year and is subject to regulatory and stockholder approval. And that's your brief, John.
Danny, thank you. I don't think we can overstate this, just how much the incoming president has changed the conversation around tariffs. Used to go on radio with Tom years ago and talk about tariffs and why we needed tariffs because China wasn't playing by the rules and that you needed reciprocity. And people in the room would look at me like I was a heretic. And now you see people like Jamie Dimon coming out on the record talking about the need for them in certain places and why.
Yeah, and the idea of them being targeted. And frankly, we saw Joe Biden keep a lot of them on and actually increase certain ones of them. So it is a bipartisan type of effort.
Well, that's what I was going to say. This is now bipartisan policy in Washington when it comes to tariffs, especially on your adversaries like China.
And just on the margin, getting an endorsement from a key player on Wall Street as well. Up next on the programme, the Morning Calls Plus, we'll catch up with Chris Marinac of Janney Montgomery Scott. We're looking ahead to some big bank earnings, including JP Morgan. That all kicks off on Wednesday. We'll get his thoughts in just a moment. From New York, good morning. One hour, 14 minutes away from the opening bell. Equity futures pulling back by 0.6%. The Nasdaq's down by 1 full percentage point. Similar move on a Russell. The small caps lower by 1%. In the bond market, check out Treasuries first, and then we can get to the gilt market. The 10-year Treasury yield just about unchanged now. So there's some good news, some comfort for the equity bulls just on the margin. 476.55, and some comfort if you've been following the sell-off in the UK government bond market as well. Gilt yields just a little bit higher, by 4 basis points at the front end, up only a single basis point on a 10-year. So Keir Starmer, the British Prime Minister, 100% confident the UK will get economic growth that we need. We'll be ruthless in our spending decisions, and the Chancellor's doing a fantastic job and has his full confidence.
Yeah, Rachel Reeves is completely safe in her position. She is the Chancellor for good reason, because she is the right person to do this job. This is according to the Cabinet Office Minister, Pat McFadden. I will just say, Bond market right now is not impressed.
Not impressed and has been pushing back.
Yes, I would think that's more diplomatic.
Over the past few weeks. Let's get you some morning calls. First up, Bank of America raising its price target on Delta Airlines to 78, highlighting its pricing power and positive industry backdrop and all of Lisa's spending. The stock is down by about 1% this morning. Your second call from JP Morgan, downgrading Constellation Brands to neutral, flagging a deterioration in consumer demand for alcohol. That stock's softer by 0.66%. And finally, Stovall raising its price target on Alphabet to 225, expecting a boost in ad dollars if the Supreme Court upholds the US TikTok ban. That stock is down about 0.7%. Let's turn to the financials. Big bank earnings kicking off on Wednesday. JP Morgan, Goldman, Citi, Wells Fargo all reporting. Christopher Marinac of Janney Montgomery Scott writing, fundamentally banks are well positioned for success as businesses and stocks in 2025. Chris joins us now for more. Chris, welcome to the program, sir. What is there to be optimistic, to be positive about for the year ahead for the financials?
So I think lower interest rates are really the key. The Fed's dropped 100 basis points, and that is a huge for how the cost of funds resets both in fourth quarter and first quarter. Obviously, the Treasury rates are backed up the last 10 days, but I think we can work through that. Overall, pricing is still very favorable for banks, which is going to allow the net interest margins to rally both in the quarter reported this week and next week, as well as what the outlook's going to be for the first half of the year. So that combined with loan growth accelerating from the Fed data in the months of November, December is very positive for the sector at this point.
Chris, we'll talk about where some of the revenue growth will come from, the tailwinds and the drivers in just a moment. Can we just sort of touch on expense management? We've all seen a lot of headlines, reports, including from us here at Bloomberg, about how strong bonus season's going to be for certain banks. Will you be focused on expense management, and where will that show up in certain places, certain banks?
Sure. So I think the bonuses will be part of the fourth quarter number. And I think to some extent you will see a higher accrual for 2025, but that also goes over to higher revenue growth. So I don't think it's an issue per se, but I'm absolutely focused on expense management. We've had a lot of companies tell us that if revenue growth goes up, that they will adjust expenses a little higher, not just for bonuses, but also just for increased spend. There are a lot of banks trying to compete with each other to grab additional personnel, particularly at the mid-sized banks, to win additional lenders and to find additional avenues for growth. That's going to lead to more spending, but I also think it's going to be matched by the expanded margin and net interest income growth that we think is happening right now.
What kind of spending do you want to see? And I'm talking in particular about artificial intelligence at a time where there are a whole host of estimates, including Brian Moynihan of Bank of America, coming out and telling us that he expects the size of business to grow dramatically, but the staff to maybe stay the same because of some of the augmented resources. How much are you examining which banks are best positioned for that?
So I think every bank is trying to get more efficient along the way, Lisa, but I also think that from the standpoint of AI, what you really can do as a bank is use AI to be thoughtful about your regulatory compliance. You know, every bank still stumbles on AML and BSA rules to some extent. We had a recent issue with B of A on that front. I think the AI can really help on that area. To some extent, the cyber world is continuing to be the biggest area where banks spend, so AI gets lumped into that. But I also think to some extent you can also make the customer experience better. And a lot of the commercial-oriented banks who have small and medium-sized businesses continue to sort of sharpen their pencil as it pertains to improving the experience to do more business with the same customers.
These are all the things that banks have some control over, at least in the near term. There are a lot of things that they don't have control over, and that has to do with policy coming down the pike. And that's been one of the main drivers for some of the optimism around mergers and acquisitions, some of the potential deal-making that really gave way to some of the optimism behind the bank trade. How much visibility do you expect to get from executives on that front?
Well, I think there's a lot of optimism about policy improving banks, particularly on sort of where the capital rules are going to go, getting mergers approved faster, as well as just the overall grinding of the regulatory community, which was very difficult in 23 and 24. That, I think, easing up as this year and next year plays out is a huge positive for banks. I just think that's going to allow them to be more on their front foot and really be more aggressive and assertive with trying to expand their business, which includes deals. So all of that policy change is out there for us to sort of take and accept. I think it's going to take us 6 to 9 months to really filter through, but I do think it's out there and it is positive in terms of where it's heading.
At the same time, you started this conversation, Chris, talking about how lower rates were actually beneficial for banks, and certainly lower front-end rates are beneficial, especially with higher longer-term rates if they can lend long and borrow short. But there is this question about what that does to the deal deal-making environment, at what point it becomes a real downside, a real headwind to potential deal-making and some of this optimism that we've heard about. Where is sort of that line in the sand for you?
So I think seeing the Treasury rates go above 5% would be one line in the sand. I think if we get the 5 and 10 year above 5, that's a huge red signal. Loan marks and fair value marks on deals are still an issue, even coming off of what's transpired the last 2 years. And we are removed from the liquidity scare, but we still have the interest rate mark scare as it pertains to higher rates. So 5% is, I think, an important line. I also think to some extent it would harm the stocks, and therefore the stocks filter down into less enthusiasm for deals. So stock prices have a role in this as well.
Hey, Chris, appreciate your take. Looking ahead to the big bank earnings later this week, Chris Marinac of Janney Montgomery Scott. Lisa, to your point, I think it's an important one. Spent a lot of time in 24 talking about surviving until 2025. Survive until 25. And a story being that you get close to 25, you get bailed out by the Federal Reserve. If you held on, they'd start cutting interest rates. That story's changed pretty quickly to kick off the new year.
And there still is this feeling that maybe companies adapt and adjust and they can keep going forward, and they've actually pushed out the maturities so much that it isn't going to be a problem. That said, some of the hope that's baked into some of these bank stocks, that there are going to be huge deal-making opportunities, that there's going to be huge issuance, that maybe even IPOs could come back. Does that make sense if you have rates that are punitive or prohibitive and that are actually just forcing companies to stay alive rather than really engage in big expansions?
But I think the deregulation is something everyone is just welcoming, because what did the JetBlue CEO say to us? It can't get worse than this. And they view this now as an opportunity to potentially go into the market when they were waiting on the sidelines because of how this administration was running their regulation.
You didn't know what kind of deal could get done. You really didn't. And I know we've reflected on this before, but I go back to the conversation we had with Brian Moynihan at Bank of America, Lisa, together maybe 9-10 months ago, when Brian turned around and basically told us very early on, there are companies that can't even have a conversation about doing a deal that would probably like to do a deal because they don't know what kind of deal can get closed in Washington.
And it does seem like there will be more deals that will be acceptable to getting done, and certainly they're prepared. I just wonder about the financing at a time where you've got yields at such high levels and whether they have the cash on board. But pretty much by all accounts, everyone's saying there will be a lot more deal making.
There must be a pipeline of deals ready to go from the last 2 years.
Yeah, well, we've heard that, right? I mean, we've heard that from Jane Fraser. It's going to be like it's just basically a hose of deals. Again, where exactly are the deals going to happen and where is the pushback going to happen? I'm very curious to see who takes over the FTC. I'm very curious to see exactly who gets through this nomination process. It's going to be taking place in Washington, D.C. I mean, there's still a lot of unknowns, and so that's the reason why the price to perfection comes into place. Or is it sort of understated optimism because they always sandbag us ahead of the earnings?
It's some of that and some of that. And a little bit of that. On Wednesday, massive morning on Wednesday morning for you. So at 8:30 Eastern time, we'll get CPI. That's the big data point of the morning. We'll also get numbers from JP Morgan, from Citi, from Goldman and Wells Fargo. And once we've got through Wednesday morning, it's on to Thursday, where you get Bank of America and Morgan Stanley and some retail sales data as well. So that 48, 24-hour period is going to be massive for markets.
It's your favorite time of the year when you actually get a lot of interesting details about the borrowers and the corporate environment ahead. Why are you laughing at me?
Because you know I hate bank earnings.
I never thought that you hated bank earnings.
And she's ditching us for it.
Fire hose of numbers
that are so instructive.
Pre-market that no one really looks at until later in the day.
And then they parse through them and come up with a story.
Drives me nuts.
It'll be fun.
The opening bout 60 minutes away. Equity futures on the S&P 500 negative by 0.7%. On the Nasdaq, near session lows down by close to 1%, and a similar move on a Russell on the small caps. With your morning movers, let's cross over to Manus Cranny. Hey, Manus.
Jonathan, good morning. A brutal moment for Moderna. This is a brutal reduction in their demand outlook. They said they're going to make $1.5 to $2.5 billion in sales. That originally was $2.5 to $3 billion. This is a $1 billion drop in terms of the estimates. Add into that losing market share. It's the beginning of the JP Morgan Healthcare Conference, so you're going to see a ramp up in information here. They're losing market share down to around 40% in the COVID vaccine market, down from around 48%. So the stock is under huge pressure, as you can see, and counting. There will be further cost cuts, but the cost cut story is not translating at the moment. Now, when it comes to deals, back in the game, J&J bidding $14.6 billion for this company, Intra-Cellular Therapeutics. Think about schizophrenia, think about depression. These are central nervous systems disorders. This is where there's a hole in the rundown, as it were, for J&J. They want to step in there. The stock is roaring higher. This is a cash bid. It's the largest biotech transaction in over a year. J&J stock, it goes meh, but certainly the specter of this helping the stock. Let's just round it off with Apple. It's a holiday season for them. They probably would prefer to forget. Overall, iPhone sales dropping by 5% globally. They're losing market share in China. They don't have the AI features perhaps that everybody wanted. But you got to hand it to Mark Zuckerberg for the killer line. Steve Jobs invented the iPhone, and now they're just kind of sitting there 20 years later. That is a brutal assessment, coming from somebody, as Danny said this morning, that went out and bought everything rather than invented a great deal of new product in his own company.
Manus Cranny, thank you, sir. Fascinating podcast with Joe Rogan. I encourage everyone to take a listen at that when you get the chance. Apple is trading at a pretty lofty multiple. So when they come out with earnings at the end of this month, this is not a good time to be missing estimates at all.
Especially at a time where there's ramping up of geopolitical tensions and just the ability to have a place in China. Given Tim Cook used to be the chief diplomat, but now does that even matter if you have national champions?
Zuckerberg's trying his best to be a diplomat as well.
Is he?
Yeah,
is that what this
the incoming
is?
administration.
Well, yeah, he was.
Without a doubt.
He was. I don't know if he was bleisering, but he was also in Palm Beach Friday night once again. I think this was his second dinner with President-elect Trump.
It's a different kind of diplomacy than we're accustomed to. I think that was sort of my point, because a diplomatic approach to things typically isn't necessarily bad.
It's diplomatic. You're saying diplomacy is generally
diplomatic.
Right.
But this is diplomacy of a different sort.
Got it. Thanks for clarifying. When did you go on vacation? On Wednesday. Skiing. Nice. Let's turn to the economy. Almost there, Bramo. Investors bracing for PPI and CPI data this week, with the December payrolls report prompted widespread rate cut doubts. Veronica Clark and the team over at Citi still looking for several cuts this year, writing it may now take several months for Fed officials to see reason to resume rate cuts. Our base case is for the next rate cut to occur in May, with 5 total 25 basis point rate cuts this year. Veronica joins us now for more. Veronica, good morning.
Good morning. Thank you for having me.
Let's get into it. Let's get to the jobs report first, and we'll work our way through it. So you were at the low end looking for 120.
Yes.
We got a massive blowout.
Yes.
So what did you and the team miss, and how are you looking at things now?
Yeah, it is some remarkable stability. I think even more important than that payroll jobs number, which of course was really big, was we saw the unemployment rate declining. And that's really where we're taking more of our trustworthy signals from. And it does look now like a couple of months where the unemployment rate is stable in this 4 to 4.2% kind of range. I think the issue for us is that just looks like a very precarious stability, because we do know that hiring is so low. If that's the case, I don't see how you don't just have some gradual upward pressure on the unemployment rate. New labor market entrants, if you do happen to lose your job, you're not finding one very quickly. But yeah, this has been a couple months of stability and might just take a bit longer for the Fed to see any more weakness. So.
Is it enough to make you question your own process, you and the team? How many more months of this would get you there?
Yeah, of course. I think I would want to see hiring pick up to know if this is a real stability or not. I think the last couple months, we had the unemployment rate moving sideways, but for a couple months there, it was alongside people dropping out of the labor force. That's not a stable situation. I think you would want to see hiring picking up, but yeah, maybe this time is different. Obviously, we have had some pretty remarkable data.
How policy dependent is this for you, given the fact that a lot of people are saying companies are waiting to figure out what the policies are?
Right, yeah, there has been a lot of uncertainty, obviously new administration. I don't think that uncertainty has really improved within the last month or two. So I think we would maybe be waiting still another couple months to know. In general, I do think a lot of the resilience of the economy the last couple years has been because we have had such substantial fiscal support. And that already is going to be fading for 2025. And now, obviously, if rates are restrictive and that's weighing on demand, well, 10-year yields are higher than when the Fed started cutting. There's a lot, I think, of policy restraint that's going to weigh on the economy.
What makes you believe that rates are restrictive?
Yeah, I mean, because we've seen labor demand weakening. We certainly see that in the very rate-sensitive sectors, housing, manufacturing. We still were losing manufacturing jobs even in last week's data. And we see hiring weak, and that seems to be not just a normalization of the last couple years of really tight labor markets and strong hiring, but it does seem to be businesses are looking to cut labor costs, and maybe that's to offset high borrowing costs. That's what restrictive rates do, and we see that in survey data, anecdotes in the Fed's beige book, and so I don't really see that picture changing.
Going back to policy, how tight can the labor market get if we do see these deportations the president-elect is talking about?
Yeah, it's going to be an interesting question, and certainly that will affect a lot of sectors. I do think over the last couple of years, substantial immigration has probably helped to loosen the labor market. It's helped to slow wages, so the reversal of that would be probably net inflationary. See upward pressure on wages again, but maybe precisely because it would impact certain sectors so much, we are not expecting big deportations.
But when you look at potentially what would that mean for the unemployment rate?
Yeah.
Do you see a tighter labor market, and then would you have to reassess how you view the labor
yeah,
market?
certainly you could. I think there's obviously a timing issue. And we don't really know if we are going to get these deportations. If they do happen, it's probably not really impacting activity until later in the year. I think at the earliest, you do have to legislate some of these policies first. But yeah, it certainly that could be a game changer. I think the issue is that's not necessarily in the next 6 months.
Deportations, and that word is highly charged and aggressively debated. You can park that and still have a conversation about labour supply. We've seen millions of people come across this border, the southern border, illegally, undocumented workers. If you're able to reduce some of that, and we've seen all of that start to be reduced over the last several months as this administration went into an election and heads towards the exit. What kind of change are we going to see off the back of that?
Yeah, I mean, that's definitely been a factor the last couple of years, and already that new net immigration is slowing. I think the issue for the data is it's really not been captured well in the data. So I don't think that's the reason the unemployment rate has risen, for instance. That household survey just doesn't capture new immigration very well. Maybe it was one reason for running stronger payroll job growth, and you can see that slow. Of course, we didn't see that on Friday.
A lot of people watching this program from outside of financial markets. If we can get wages up, that's good news, not bad news. That's fantastic news.
Right.
Is there any reason to believe it's stagflationary?
Yeah.
Because that would be bad news.
Right, absolutely. And some, potential policy changes certainly could be look stagflationary at least. Deportations is one of those. You can get the upward pressure on wages, but you're going to see some bad economic data if you're deporting a bunch of people. That's going to weigh on activity. So there are those risks. But I think for this labor market, we do see wages slowing. You see that in the employment cost index, the Atlanta Fed's wage tracker, and that makes sense with an unemployment rate that has risen. This is a looser labor market than a year and a half ago.
So just quickly, CPI, PPI this week, you're confident we're still on this disinflationary trend?
Yeah, I think so. I think a lot of the inflation data still look weird. A lot of the components are not quite normal, but we are starting to see finally things like shelter inflation slowing, and that's been a really sticky, strong component for a while. It could probably look pretty volatile, but the trend looks more favorable there. So yeah, even if you get some surprises in certain components, this does look like inflation that's slowing for now.
Veronica, it's good to see you.
Thank you.
As always, thank you. Veronica Clark of Citi, still looking for 125 basis points of cuts this year, when the market's getting closer and closer to zero. Mike McKee, our economics and policy correspondent, joins us now for more. Michael McKee, a ton of data this week and a sprinkle of Fed speak as well. What are you focused on?
Well, obviously, we're focused on CPI, John, because that's going to be the major number of the week. It's going to be the number that moves markets that are already very nervous about inflation. We get PPI tomorrow. PPI is expected to rise significantly on a year-over-year basis, and that could scare some people. Maybe the creak in the floorboards before the guy from one of those horror movies shows up. And that could be on Wednesday when we get CPI, and CPI is expected to rise to 2.9%. On a core basis, 3.3%. And that's not what you want to see. We have so far seen inflation as measured by the CPI bottom out in September, and it's been moving up every month since towards 3%. And you got to wonder, when do the markets get really scared? And I don't mean just pushing up rates, but when do they start thinking about the Fed actually raising interest rates to fight inflation? I'll leave you with this thought, John. What's the 2-year note yield right now?
4.40.
You know what the Fed funds rate is?
Around 4%.
4.33. So at this point, the 2-year note, for the first time since the Fed was raising interest rates, is now above the Fed funds rate. And that basically suggests people are starting to think about the idea of rate hikes.
Mike McKee, getting closer, that's for sure. Appreciate your time. Adam Posen, the first out the gate, suggesting that could be a reality. And I have to give Adam Posen repeated credit for this. He was talking about this back in August, before we got that Jackson Hole speech from Chairman Powell.
And it's now become an increasing conversation with Bank of America piling on and basically saying there is this increasing risk the next move is a hike. You just wonder at what point that is what's really factoring on some of the sell-off that we're seeing in the equity market.
I thought we were about to do a pop quiz with Mike McKee then. It's on the edge of my seat. Where's the S&P?
Yeah, exactly.
Brent Studi of Northwestern Mutual joins us now. Brent, coming into this year, the average forecast on the S&P was about 6,600. We've had a strong data point, a sell-off in bonds, and the bears started to come out. Can you give us the reasons to be confident, optimistic, if there are any left for 2025, please?
Well, I guess I'm more towards the cautious side, not the optimistic side, and that doesn't mean that you should obviously sell all your equities. But I think the conversation that you're having is a real one. We have higher interest rates. I think the hope was the Fed would be able to cut rates, and that would alleviate pressure on parts of the economy that have been harmed by interest rates. Think about housing, think about manufacturing, but that is not what is occurring. And you did see a strong jobs report last week, but you also saw inflationary pressures. The ISM services prices paid spiked at 64. I don't think anybody talked about this too much, but the University of Michigan 5 to 10 inflation expectations rose to 3.3%, and you actually saw some sort of return to inflationary psychology where people were buying in advance. And so we kind of have this odd thing going forward where we have to worry about what does the Fed do next. And the reality is higher interest rates are here to stay, and that means they continue to work their way into the economy. That means asset prices have to reflect those, and that's where I think there's valuations right now that don't make sense with the 10-year Treasury around 475.
Where do you find those valuations, Brent, in certain sectors, certain groups of stocks across the S&P? Where's that more concentrated, that risk?
I think the concentration is more in the S&P 500, where the risk of high valuations is certainly out there. Look, the S&P posted its second 20% plus gain, but it was narrow again. If you look, less than 30% of the stocks actually beat the S&P 500, which is the second time in a row. So it did it in 2023 and 2024. To find similar numbers like that, you have to go back to 1998, 1999, which scares me just a bit. And then before that, 1980 and 1973. The thing that ties all those together is that it was a later cycle economy where the economy had become more bifurcated, and that's led to bifurcated markets. We think there, ironically, are opportunities on the other side. The market tends to broaden after that. Now, whether or not we have to have a recession to kind of cleanse that is up for grabs, but we're positioned more for the broadening because that's where valuations are cheap, even though I know higher rates harm those parts of the economies like small caps, mid caps, the equal-weighted S&P 500. I do think one way or the other, there is a broadening on the other side. And since we're intermediate-term investors, that's where we're focused.
So are you just basically hoarding cash right now, waiting for that to happen, for there to be some sort of blow-off in the top and then head into that sort of broadening out trade?
No, I mean, we're not hoarding cash by any means. We stay fully invested. But certainly we're more positioned with a tilt towards those areas. We do still invest in bonds, and we think that you should invest along the curve. I mean, even at 475, that's an attractive yield. It does reflect some worries of inflation that are out there. I think one way or the other, the Fed will get this under control. It just may take a little bit of tightening in between. And so that's where we're just a bit more cautious right now towards the overall equity markets.
Someone who is bullish on the equity markets might say, what do they need to get under control? What this is an economy that's managing just fine with 4.25% rates, benchmark rates, and that basically you have this engine of innovation and some of the big tech names that continue to deliver at this transformative time. Why is that not convincing you?
Is that already priced in? That's the first question I would ask at the earnings multiples that we're paying for that. The second question is, does the Fed want to get inflation back to 2% or not? We have not been at 2% yet. And people always say, well, isn't it close enough? Look, I don't know. That's the kind of psychology that existed in the 60s that led to higher inflation. And that's where I just believe they're going to have to try to get it back under control. And those numbers that I mentioned last week, the University of Michigan 5 to 10 year is something the Fed's pointed to. And that's a real thing. If inflation psychology changes, that could be kind of making inflation more embedded from what it's been in the past, which is kind of just more of a temporary thing, I think, or transitory thing, dare I say that, more tied to COVID. I think it's now becoming more embedded where people are expecting it longer term.
T-word was banned a long time ago. Brent, you know the rules. Brent Shitty of Northwestern Mutual.
Monday morning, I forgot.
Brent, appreciate your time, sir. Thank you, buddy. Thank you very much. Certainly the mood has changed on the FOMC. You've seen that in the official communication we've had from a handful of members over the past week, showing some discomfort with inflation.
Discomfort with inflation. I think that the increasing question becomes, how low is the bar for them to start talking about the possibility that they'd have to hike again? It's one thing to not hike for the remainder of the year, but that's another step to actually become more restrictive.
And how much tension is that going to cause with the incoming administration when you have a president-elect that wants rates lower? This is a real estate guy that wants to see rates lower. He doesn't want to see the Fed hiking.
Wants rates down, wants the dollar weaker, and has some policies that might push things in the other direction.
Which will lead to the Mar-a-Lago Accord, and Mark McCormick is volunteering his services as head of Canada.
He's not the first to say that yet, you know.
I know, well, that's what it might lead to.
I think all it takes is that you just get some finance ministers together and just start saying a couple of things, and you see things shift the other way pretty quickly.
Yeah, but what would that deal look like? I'll give you this factory.
I don't know.
And then you give me this.
Who wants to play ball if you're going so aggressive on tariffs is another question as well.
Maybe Greenland.
We'll see. Greenland? OK, that's a conversation for another day. A long conversation, an important one at that as well. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. The wildfires in Southern California have killed at least 24 people and destroyed more than 12,000 buildings. Over the weekend, firefighters got a brief break from the dry Santa Ana winds that have spread the flames across nearly 38,000 acres. However, another round of wind gusts is expected to pick up later today. The National Weather Service issued a rare, particularly dangerous situation red flag warning for parts of Ventura and Los Angeles counties from early Tuesday morning until noon on Wednesday. Tesla has beaten Audi in global car sales for the first time, even though Tesla sold fewer vehicles than expected. The VW-owned car maker suffered a 12% slump in total vehicle sales, hit by competition in both Europe and China. Audi's EVs declined also, dropping 8% to around 164,000. Venture Global is seeking up to $2.3 billion in its IPO. The second largest U.S. producer of liquefied natural gas plans to sell 50 million shares in a prelim range of $40 to $46. It plans to float on the New York Stock Exchange. And that's your brief, John.
Danny, thank you. Thanks for this morning. Up next on the program, setting you up for the week ahead. You're watching Bloomberg Surveillance. $40 minutes away from the opening bell and recovering just a touch. We're off session lows on the S&P. Still negative, though, by 0.6%, down by 0.9 on the Nasdaq and down 1 full percentage point on the Russell. In the bond market, the shape of the curve for you, 2-year, 10-year, 30-year. The 2-year just about unchanged, around 440. Lisa at 438.77.
Yeah, to me, this is a real question. At what point do we start talking about the potential for some sort of increase in rates by the Federal Reserve at a time where this market's all but pricing out rate cuts entirely for the remainder of this year?
Deutsche Bank, Matt Lazzetti, he said it early on. Now you've got Aditya Bhav and the team over at Bank of America saying the same thing to kick off this week, looking for no rate cuts in 2025 from the Federal Reserve. And this won't help. Crude, Brent, WTI rallying today. Brent crude went through 81 earlier on, $80.90. Amory up by 1.4%. WTI up by 78, up by 1.9. This is not just about the economic data. It's not just about growth. This is about policy down in Washington.
This is about sanctions, the boldest, most significant we've seen yet on Russian companies, on the vessels that carry Russian crude, going after two large oil producers, Gazprom Neft and Surgut Neftegas. Maybe never heard of it, but it is certainly impacting. One analyst put it at 800,000 barrels of potentially that's going to be impacted from this. And the critics are saying, why is the Biden administration doing it now? They are leaving. They are heading towards the exit. And you'd have to think they're doing it now because gas prices for the domestic consumer are no longer their problem.
Talk about poisoning the well on the way out the door. That's pretty shocking stuff.
And given the fact that potentially the incoming Trump administration, if they were going to do a deal with Putin, I imagine Putin is going to want sanctions relief, part of any deal he does with Ukraine, with the U.S. potentially negotiating that. To get these sanctions lifted, you cannot just go to the Treasury Department what one analyst was saying who really needled through all of the language,
sure,
they have to go to Congress and get congressional votes to lift these sanctions. What's going to happen with some of those hawks in Congress that say, no, I want to keep Russian crude off the market?
This feeds into some of the fears that I think market participants have right now. It's not just about strong jobs numbers. Inflation expectations picked up in New Mitch on Friday. Now, you can sit here and say that is a ridiculous number influenced by politics, and I would sit here and I would agree with you. But I'd pick up on that argument from Peter Sheeran Academy. There is just a worry that the Fed will respond to that. The Fed has responded to you, Mitch, before. It's responded to these things many times in the past.
And just to take it a step further, it just increases the temperature that much more for Wednesday's CPI print, because if you get a hot CPI print on top of expectations increasing, it'll be a lot harder to ignore. You add commodity prices increasing to that, it becomes pretty fraught. And that, I think, is the concern that people have.
Let's get to the calendar. Elisa mentioned CPI. Before we get there, tomorrow, PPI and Fed speak from John Williams of the New York Fed. I think that is going to be a really, really important one. If he offers any colour whatsoever on his expectations for interest rates, bear in mind, there's a handful of officials in the FOMC right now who are uncomfortable with inflation. There was one governor in the past week that didn't seem too uncomfortable, and that was Governor Waller. Fed President John Williams is part of the big trio. The vice chair, the Federal Reserve chair, and then you've got the New York Fed president. What he says on this issue will carry a lot of weight to this market before we get to Wednesday, when we get CPI and big bank earnings kicking off with JP Morgan, Citi, Goldman and Wells Fargo. On Thursday, more earnings from Bank of America and Morgan Stanley, plus retail sales and another round of jobless claims. We'll also be keeping a close eye on Los Angeles, with the city bracing for Santa Ana winds to pick up again this week. Just for a brief note and an update on what's happening over there, we can catch up with Zohreen Shah, joining us from Altadena. Zohreen, give us the latest, please.
And the anchors just Matt or Matt and Shanali for this?
Yeah, the latest is that the death toll is 24 people. The missing count, 16. One of my own neighbors is one of them. His family does not know where he is. And right now, a lot of people are just really fearful that their community could be next. The winds are expected to pick up again. You know, we're here in Altadena, where I know 3 people who have lost their homes, and they're incredibly afraid of not just the next coming days, but just the future, but how they're ever going to insure their homes again, and what the rebuilding process will be like. So a lot of stages of grief and emotions here.
Zohreen, appreciate the update, and no doubt you'll be giving us updates throughout today on Bloomberg TV and on Bloomberg Radio. Things set to get worse and not better. There's a real fear of that in the coming days.
It's horrendous, and people are trying to be very delicate as they fight a fire that is still very much a threat, still at some of the more severe threats, while also looking forward to the rebuilding effort and just how to recover. It's a really horrific situation.
We'll bring you updates throughout the day, of course, right here on Bloomberg. Coming up tomorrow, we'll be hitting the ground running, catching up with Stuart Kaiser of Citi, Emily Rowland of John Hancock, Libby Cantrell of PIMCO, and Venu Krishna of Barclays as we await some economic data. PPI tomorrow, CPI on Wednesday, retail sales on Thursday, and tons of bank earnings coming up on Wednesday and Thursday. From New York City this morning, good morning. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.